All right, so today we're going to talk about trading direction and the use of implied volatility in directional trading, um, and how it can really change the way you trade. So first, a little bit about me. That's me. Believe it or not, she's not that tall. She's wearing heels that were like probably 6 inches tall, and I'm short. So you know, it was a bad combo, but Liz Clayman's maybe 5'2". Um, my name is Mark Sebastian. I was a floor trader for a little under 10 years, and since then I have been doing a combo of kind of managing my own money and doing consulting services and education services. So at Option Pit, we have a wing that deals on the retail level and works with clients, teaching them how to not lose money trading options and hopefully how to make money trading options. And then the other side is professional consulting. So we do a lot of work with advisors and hedge funds and things like that. Basically, a lot of times we'll go through and you know, help people implement strategies, or we'll look at people's strategies and tell them what they're doing wrong. And most of the time, they're doing a lot of stuff wrong. So that's me. That's Option Pit. I'm going to make this offer at the end, but we've got this boot camp coming up beginning August 13th. It's going to be 6 hours of live trading, a 4-day boot camp, and it's going to be we're going to teach you about the wheel trade, increasing profitability in directional trades, and how to manage trades to reduce risks and maximize profits. Cover everything from really basic covered calls all the way through things like iron condors and butterflies and really advanced stuff. It's going to be really good. If you use the code INSIDER, so the camp is normally $400. We're doing $147 right now. But today, if you sign up before the 31st and use code INSIDER, it'll take 20% off. All right. So instead of 147, it'll be, you know, around you know, $1.17, $1.18. That's not bad. All right. So let's talk directional trading. So what we're going to talk about is how volatility can act like a headwind or a tailwind to successful trading. All right, and how using volatility will help with basic buy-sell decisions to profit from directional trading. So when should I buy an option? When should I sell an option? All right. Then we're going to discuss how strike selection can make the difference between a good trade and a bad trade. There's nothing worse than being right and still losing money, and that's where strike selection really matters. And then we'll talk about, you know, a couple of combinations of buy and sell and strike decisions that can really pay off. I'm going to tell you my favorite trade on directional trading. All right, and I think you'll like it. So, options and stock. The key to trading options for direction is correlation. All right, that is really the key to all options is understanding correlation. Correlation means how one instrument moves with another. All right, a correlation of one means the two will move perfectly together. A correlation of an option can never be greater than 1 or less than -1. All right, whereas stocks can correlate, you know, at 3 to 1, 4 to 1. The correlation of an option will never be greater or less than 1. All right, at its most, an option will correlate at a perfect 1 or a -1. All right, delta. All right, and this is the big Greek we're going to talk about. Delta is the option trader term for correlation. In math, this can also be called slope for those of you that are big into calculus. You know, why did we call it delta? Well, guys just didn't want to call it correlation. I think that's my theory, right? They said, well, it's correlation, but let's come up with something cooler so that what we do sounds more interesting than it is. So they came up with delta. Delta can change with the passage of time, change in price, or change in one really important factor, and that factor is volatility. It can be described in many ways, but obviously correlation is the most common. Thus, options with a positive 0.6 delta will make 60 cents for every dollar the underlying rallies. it will lose 60 cents for every dollar the underlying falls. That's if it's at a positive 0.6 correlation. All right. What makes delta so hard relative to a stock is that it can change on a trader. And this is really the key. This is what throws people off. There are some drivers in change in delta that are easy to understand, like price movement and passage time. And the one that can really screw with people's heads, like I said, is volatility. And that is the one that most commonly causes people to think they should make money and not make money. All right. Does anybody have any questions so far? Do we all get what correlation is and what delta is? All right. If you're not clear, let me know. All right. So tell me this. So this is probably. Let me know if this is happening to you. All right. Mark, market makers are such. This is the voice that my brothers and sisters make for me when they think I'm talking out of my butt. So you ready? Mark, market makers are cheaters. I bought all these calls right before earnings. The stock is way higher, but I'm not making any money. Market makers are taking my money. Let me know if you have not said that recently, at one point in your time, you probably did. If you didn't know what you were doing and you started trading options, all right? No one is trading your money. No one is taking your money, all right? No one's like, oh, I saw Bill buy these calls, and now that the stock's up, you know what I'm going to do is I'm going to slam these calls so they're worthless and drive Bill nuts, all right? It'll be hilarious. No one's taking your money. Delta changed. All right, one of your major assumptions changed, and that is the key. Let me show you just kind of a quick example. All right, so we'll look at Apple. All right, everybody loves Apple, right? It's everybody's favorite stock, right? And let's just look at, we'll just pick a random strike. Here's August. All right, so it's right before Apple earnings, and I think Apple's going to infinity. So I'm gonna buy the April 102 calls, or the August 102 calls. All right, I'm gonna buy one of them. All right, if you look at the center chart, you can kind of see this is what it looks like. All right. This is live vol. All right. Now, what I want you to look at is, let's say that I'm right, and Apple is up 2% on earnings, or basically like it was the morning of. All right. So with Apple up 2% on earnings, all right, I'm going to drop, but volatility in, let's say, 50%, all right? So if volatility goes from 40% to 20%, so take a look. Prior to the volatility changing, the model is saying I'm making $44. And look at my delta. It says I've got a delta of 28 on my calls. With volatility in 50%, my delta is only 12. So what happened is I actually lost 16 deltas, and my P&L goes from making money, making 44 bucks a contract, to losing $25 a contract. This is not think or swim. Okay? This is called live vol X. All right. This is free. Michael, I get this for free because I trade through LiveVol. And yes, even their analytic, even if they made me pay for their analytics, I would buy it. It's that good. Hi, Rick. All right. So delta. All right. The Greeks, including delta, are produced by a pricing model. All right. They are, and this is what throws people off. They're not real. All right. They are modeled risk based on inputs into the model. They're meant to help traders manage the risk of a given option position. Thus, Greeks are an output of a model. They are not a hard number. They're not a real number. All right. And have you ever heard the term garbage in, garbage out? Yeah. And that is directly from modeling. All right. If you have the wrong assumption in your model, then its output is going to be wrong. And that is what happens with delta. So when I'm running a really high implied volatility, and then a move happens, and I change my volatility going forward to a much lower one, my deltas will change. All right. Implied volatility. So what makes trading volatility different than trading a stock? Over the long term, we know where implied volatility of a stock or index is going to go. We do not know where the stock price is going to go. All right, and that's because implied volatility mean reverts. Much better on indexes, but here, let me just kind of show you. So here's a chart of Apple. All right, notice kind of the 50-day and the 200-day moving averages, right? Just kind of go where they will. All right. Now here is a chart of VX APL, which is the VIX of Apple. All right, and here it was kind of downtrending, but if you look at a chart of it, it has a mean to it. It has an area that it stays to. All right, it will have huge swings higher and big swings lower, but it will always kind of come back to the middle. All right, that's what's different between a implied volatility level and a stock level. Stocks will go wherever the heck they want. Volatility cannot and will not. All right, it can go wherever it wants, but it can't stay there. All right, and that's what's so different. All right, mean reversion. All right, a stock price can go anywhere and stay there. Volatility can go anywhere but won't stay there. All right, understanding when vol is high and vol is low can help with buy-sell decisions. All right, so now let's talk about basic buy-sell decisions. Now that I've laid some foundational knowledge, we're going to talk about buy-sell decisions in trading for direction. All right, in general, when implied volatility is low, all right, in the near term and especially in the long term, and one wants to play direction, it can make sense to buy over sell. All right, when implied vol is really high, it typically makes more sense to sell options or call and put spreads. All right, so now let's talk about getting long. All right, when one wants to go long, one can sell puts or buy calls. Each trade acts very differently despite being long the underlying or having a long correlation to the underlying, if you will. All right, a short put is long delta and short vega or short volatility. All right, so short volatility, thus the trader is hoping the stock moves higher and that implied volatility comes in. All right, so the trader is betting on less volatility. All right, so what makes implied volatility drop? Implied vol drops because HV drops. What's HV? That's historical volatility. All right. When historical volatility drops, so does implied volatility. Here, I'll just kind of quickly show you. Let's look at Apple. Wrong chart. Come on. So this is implied vol versus 20-day historical. And you can see when it's dropping, typically so is volatility. It's even more so in something like the S&P 500. See? As this number is as the blue line, which is historical volatility, is dropping, you can see the red line is, which is implied vol, is slowly dropping as well. When you get a little rally, you get a little rally out of implied. All right. So thus, a short put is actually a play on lower realized volatility. When you sell a put, you are betting on less market movement. When selling a put, the trader is really betting that the underlying won't go down. All right, now, here's a class example. Look at IBM. All right. All right. See how see how it's not having a lot of movement, and the vol is kind of high and way higher than historical volatility. See that? So it's not moving that much. It's just kind of creeping higher, and vol is trading at a big premium. This is a perfect put selling opportunity, or put spread selling opportunity. All right. You've got implied vol trading at a big premium, no major events coming on, and a slow creep higher in the underlying. Perfect time to sell puts. All right, a long call is long delta and long volatility, long vega. All right, the trader is hoping that implied volatility goes up, and the underlying goes up. All right, and realized volatility goes up. All right, so what makes this happen? An increase in movement and an increase in expected movement. All right, so with a short put, because you're selling it, because you're hoping volatility drops, because you're getting short volatility, you're actually really just betting, hey, this isn't going to go down. All right, when you sell a put spread or sell, you are saying, I'm guessing that the underlying is not going to fall. All right, because you make money whether it rallies or sits. All right, when you buy calls, you are betting the stock is going to go higher, straight up. So here's INTAP. Right, and we had this one on at one point in our strategy letter. Vol just got disgustingly cheap. It kind of bounced off this super low level. We went long calls and cleaned up. It's pretty nice. All right. Like going long, when one is making buy-sell option decisions, one must take implied volatility into account. When implied vol is high and one thinks the stock is going to go down, sell calls or call spreads. When IV is low and one thinks the stock is going to fall, buy puts. Real simple. I'll show you a recent example of a play that has worked out. So short calls. Here's SLV. You can see volatility was really high in here, and the stock had kind of dropped, but I think a lot of people thought it was going to drop below 20. But they weren't sure kind of how much, and vol was through the roof. Perfect chance to sell calls or sell a call spread. Now here's buying a put. Here's IYR. All right, that's the financials. So here you've got really, really low volatility. All right, and we're going into some tapering stuff. We've got all kinds of things on the horizon, and the vol is trading really cheaply relative to historical. Look at that. See that? So it's moving around, and yet it's trading at a huge discount. Perfect chance to buy puts, and you killed it. Really simple. All right. So here, I can point out a couple of ideas now. So like one of the scans I like is kind of what's at its 52-week low volatility. So a name that I was looking at just this week was Netflix. All right. So let's look at Netflix real fast. So I'm gonna turn off HV. And this is a 2-year chart of volatility in Netflix. Check that out. You think that's cheap on a historic level and in a near-term level? So do you think I'm looking to buy options or sell options here? Yeah. Yeah. Absolutely. So I don't care if you think it's going lower, and if you look at the underlying chart, it's an ugly. The chart just it completely broke. Really weird. So I think it's going to creep lower. It's a perfect time to buy puts. We'll see. It's settled below its 50-day moving average for those of you. If I wish I had a value chart to look at to figure out whether Netflix was going higher or lower. Boom. So yeah, I mean those are the type of things, and then I'll look for high vols too. What's really crazy expensive. Now it's earnings, so that can be a pain, but like WAG. So WAG's already had their earnings, and look at the implied volatility. That's because this whole inversion thing. You don't think? Well, no. What do you think I'd want to do here? Do you think I'd want to buy it or sell it? Buy options or sell options, depending on where I thought things were going. You absolutely want to sell. See, it's that simple in terms of buy sell. What you want to do. Now, these are two extreme examples where it's kind of painfully obvious. But if you spend some time looking at this stuff and learning about implied volatility, learning how this stuff works, it's not that hard to pick up, and it will make a big difference. All right, so now let's talk about strike selection. All right, it can make the difference between a good trade and a bad trade. So the next step, once you figure out whether you want to buy an option or sell an option, the next step is to select the right strike. All right, this is done based on the certainty of the next vol move. All right, when one believes that implied vol is going to go up, all right, I'm going to teach you about a concept called a soft delta. Softer deltas make sense. All right, one believes that IV is going to be stable or go down. All right, hard deltas can make sense. All right, and we're going to talk about what those are. Hard versus soft. A hard delta is relatively resistant to change in volatility. So if volatility changes, your delta is not going to change very much. All right. A soft delta is extremely dependent on a change in volatility. So if volatility changes, the delta is going to change. All right. That is a soft delta. Right. Understanding the difference can make a big difference in strike selection. All right. So what is a hard delta? When would you want a hard delta? All right. When one isn't sure of implied volatility's future movement. All right. When implied volatility is very high. All right. And this is on buying. All right. All right. When implied volatility is high, and this is on buying, right? Or when one isn't sure of the severity of the expected move but wants to have limited risk. Okay. So here's Goldman Sachs. All right. And look at where the volatility is. And let's say I think the stock's going to go higher. All right, with the volatility here, I could sell a put spread, but let's say I'm intent on buying something. And I just want to kind of show you how hard deltas work. All right, so Goldman's trading, about 120, 118, 119, something like that. All right, I can tell you exactly. It's trading a little over 115. All right, I can buy the DC 110 calls, or I can buy a bunch of the 125 calls. And then you can see on the 23rd, after the stock rallies, stock does rally, vol drops significantly, right? So take a look. Stock goes from kind of 115-ish up to over 120. Vol drops from 31 to 24. Nice drop. So let's talk about these two scenarios. All right, if I buy one Goldman Sachs December 110 call for $7.60, I'm buying 83 deltas. All right, or I can buy 8 of the Goldman Sachs December 125 calls for 96 cents, and I buy 130 deltas. All right, I spent $768 doing that, and I pick up, theoretically, 47 more deltas. So in theory, buying 8 of these calls has more directional exposure than buying the 1DC 110 call. On the 23rd, so about a week later, I could sell my Goldman Sachs December 110 call at $10.65. It's a profit of $3.05. All right, $305. Better than a hole in the head. Or I can sell my 8 Goldman Sachs 125 calls at $1.19. It's a profit of $1.84, or $184 for 8 calls. So even though I was long more market exposure in buying calls, and this is what happens to people prior to earnings, I made way less money because I was buying a bunch of soft deltas and the model changed on me. They were really sensitive to changes in volatility. All right? I actually wasn't long as many deltas as I thought. How did I calculate 86 deltas? $83 deltas. 83 deltas was kind of the average between the two. Oh, you know what? Actually, I was looking at the wrong strike. It's 70 deltas. So you end up at 87. So it makes it even more obvious. I think I got this one right? 17 times 8. Yeah. That's right. But makes it even more obvious. How can you buy over 100 deltas? All right. Because I'm buying 8 contracts. You can never have more than 100 deltas in one contract. But if I buy 2 contracts, I can have 200 deltas. If I buy 3 contracts, I can have 300 deltas. If I buy 4, and so on and so on. All right. And the soft delta, and this is what I was talking about. Why is delta soft? Because it's really sensitive to volatility. So the change in volatility, so take a look here. All right. On the 110 calls, implied volatility drops from 29 to 27. On the 120, so it drops, call it 2 points. On the 125 calls, on the rally, implied volatility drops from 26.5 to basically 22.5. All right, so that soft delta is very sensitive to changes in volatility. As volatility changes, the delta changes. Mark, example of soft delta was earnings related, but doesn't IV follow prices outside of earnings, making the in the money strike superior to out of the money when bullish? Not always, all right? There are times where if you're bullish and you buy cheap volatility, vol can go higher, even without earnings. Based on this example, in the money deltas are hard deltas, whereas out of the monies are soft. Yeah, that's actually probably a pretty good generalization. All right, so here, I'm going to show you this, but take a look. I'm going to show you a more recent chart of Goldman Sachs, and this is one I traded off of. So let's just look at vol. I'm going to show you a 2-year chart of Goldman Sachs vol. All right, and let's just look at, we'll pull up the 23rd. Here we go. All right, so here we are at the lowest vol, at the 14.4 vol. July 17th. Goldman's already had earnings. And I can go out and buy the August regular calls. I can buy like the 175 calls for $1.10, and they're 14.8 vol. All right. So look, the vol actually went up, and you absolutely killed it on those calls. You did way better buying, on an equal dollar basis, buying the 175 calls than the 170 calls. You did way better. So no, volatility can rise on a rally. What is the name of the platform? Live Vol X. It's actually cheaper than IB. And my clients get a special discount, actually. So if you're a client of mine, you get special discounts. Yeah, you need 35K to open an account. That is true. So maybe we needed the hard delta when IV percentile is high. That's exactly right. When vol is really high, you either need to sell something or buy a hard delta. All right? When IV is high, you sell soft deltas and you buy hard. When IV is low, you buy soft deltas and sell hard. Real simple. I'll keep going. All right, so now here's IBM. I think they use their own internal stuff. I'm not a. You're welcome. I'm not an expert on data feeds. I'm sure you understand. But I know that they're actually the data supplier to SIBO. I do know that. So here's IBM, and you can see volatility is in the toilet, right? Now let's look at how an out-of-the-money call would do there. You got the DC 185 call. I can buy for 670, 680, or I can buy the 195 calls for $1.22. Buy 75 deltas versus, a number of 29 delta calls. So let's look at what happens here. IBM on the 21st closes 190. The 185 calls are $6.80, 75 deltas. All right. Or I can spend, and I spent $680, or I can spend $610 and buy 5 of the December 195 calls for $1.22. And buying 5 of those, I get 145 deltas of exposure. All right. I use Thinkorswim too. Thinkorswim's great. All right. On the 23rd, the stock is up over $3, and I sell one December 85 call at 9:30 for a $250 profit, or I could sell my 5 calls at 225 and make a $515 profit. So you see, in the first case, I bought all these deltas, but they didn't really perform the way I was expecting. In the second case, they did. And that's really where soft deltas versus hard deltas can make a huge difference. All right. So now, here's my big combo. All right. This is the trade. So do you guys know all the VIX methodologies for that the SIBO puts out for individual equities? There are a lot of them. So if you don't have live vol, if you have live vol, by all means, use the scans that I use. But you don't necessarily need those. So follow the VIX methodologies. There are 5 big equities that I think a lot of you trade that actually have VIX indexes. All right, you've got the VIX for Goldman Sachs, which is VXGS. VXAPL is for Apple. All right, VXAZN is for Amazon. VXGOG for Google, and then they've got VX. They've got one for silver. They've got one for gold. They've got one that's the gold is GVZ. They have all kinds of different ones that they use. So when a stock hits a 52-week high or a near-term high, all right, and the VX index hits a 52-week low, try buying an out-of-the-money call that is about a 20 to 30 delta. All right, I think you'll be happy. That is an approach that I use all the time to go long. When I see a stock hit a dirt cheap implied vol, all right, I almost always use it to go long. So, and I'll walk us through a couple of trades here real quick. So, in summary, volatility reverts. Implied volatility helps form positions. There are different types of delta for different types of positions. Is the position sensitive to change in IV? That's when you go for hard or soft deltas. So, again, my option boot camp begins August 13th. It's a 4 days of 6 hours of training. Go to optionpit.com/bootcamp. I'm going to teach you about the wheel trade. All right. The wheel trade is the way that I like to get in and out of stocks. I'm going to teach you about how to increase profitability in directional and non-directional trading, and I'm going to teach you some things about portfolio risk. It's going to be taught live. Recordings will be provided the next day after each session. So there's one on the 13th, one on the 14th, and 2 on the 16th. It should be a lot of fun, and you will be missing out if you don't catch it. All right. Yes, the recordings will be provided. All right, and then it comes with 1 free week of my chat room as well. So that'll be a nice little thing. I've only got 97 seats remaining currently. All right. So do we have any questions? And I'll take a couple of questions, and if you want, I'll look at a couple of trades, and then we'll give away a book. All right. So questions, comments, thoughts on the presentation. Hopefully your comment is, this was garbage and a waste of my time. I try not to do that. I'm glad. That makes me happy. Software's held delta to IV future change. All right, so if you think implied vol is going to drop, all right, you either sell a soft delta or you buy a hard delta. Okay? All right, a soft delta is going to be something out of the money. A hard delta is going to be something in the money. So anybody you know, if you think the underlying is going to drop, do I have a beginner's guide to directional trading? Yeah, that's going to be my silver course that we do. And so when you think vol is going to drop, you buy hard deltas and you sell soft deltas. All right. When you think IV is going to rally, you buy soft deltas and sell hard deltas. That is how you put those two together. It's simpler than you think. All right, so let me show you. Here, we can look at a couple of trades. Why don't we, anybody pick a stock? Margin-wise, is more beneficial to trade options on index futures than index options. It depends. If you're using Reg T, margin can be much better, but you have liquidity issues on some of the index ones. BA, Boeing. All right, here's the Boeing Company, Chicago-based The Boeing Company. All right, so let's take a look at what this thing has historically done after earnings. So they just had earnings. And you can see we got a nice little drop and then kind of a rally right back. And that seems to have happened a few times, doesn't it? So what do you think? You think it's going higher or lower? Oh, I mean, the idea of volatility is the key to condors and butterflies. All right, grasping how volatility is going to move and where it is relative to itself is how you determine whether you buy or sell. All right, well, I'm looking at here and I'm guessing volatility is going to be going lower. Honestly. So does tech analysis work on IV charts or based on underlying? IV chart, because IV is so mean reverting, it's all about kind of understanding where is the current level relative to where it's been trading and relative to where it might trade. All right, so I'm looking at this stuff and I'm saying that I think this is probably something. This is an advanced. The boot camp should not be an advanced course. It is a, on a scale of 1 to 10, it will hopefully bring you from a 2 to a 4 or 2 to a 5. Are there periods of time where IV can stay either much above or below its IV? IV can stay below its long-term HV or mean for an extremely long time. Now, on the flip side, it typically does not stay extremely high for very long. All right. And what are the factors? Well, I mean, look at what's been going on in the S&P. The S&P is going through like about a 6-month period of being extremely low relative to its implied vol. All right. So this is one where I would look at selling. So I might look at, let's pull up an option chart. I'd probably look to see if I could find an expensive contract that has some meat to it. And, take a look here. These are all implied vols. That's what sigma is for them. So ignoring the July 25s and knowing that I would either do the weeklies or like the Aug 16s. The Aug 16s have a little more teeth to them. But I would be looking at, with this thing at 123, I'd be looking at selling like the, probably like the 125, 127 call spread. That's not a bad risk reward. Something like that. Because I'd want that IV exposure. All right, give me one more name and we'll look at it. SPY. What option for Tesla? I'm not playing. Tesla is the sold to you. Anybody that wants a long-term long on Tesla. But they've got earnings coming up, so that's going to change how you're thinking, right? And it's definitely going through some cycles. It's got earnings on the 31st. Honestly, I'm looking here. I would probably be buying options here. I think that looking at Tesla, I mean, you got to think that vol is going to go a lot higher. I would be in August. I would probably buy some sort of. I would probably buy in the direction I thought it was going to move prior to earnings because I think vol is going to go higher. Buying calls. I would probably. I think you want to even though I think vol could go higher, I think you probably want to lean a little bit towards soft. Is it really? I'll fix it. 1 second, folks. You can see how the how the sausage is made. Here we go. Oh, you know what? I'm sorry. I put a 3 in there instead of a 4. I'm a dummy. All right, it'll work now. Sorry about that, folks. If vol goes higher, would that mean the stock is going to go lower? No, you can have vol rally and a stock rally. Actually, interestingly, when an underlying is really rallying and its implied volatility is rallying with it, that is one of the most bearish stock signs that you can see. There are a few things that I'm going to teach you during the boot camp that are going to change the way you look at directional trading. It'll actually open up some major. You go, yeah. For Tesla, I'd buy calls because vol is going to go higher from here. All right, the stock could go lower on. I mean, the boot camp. All right, buying calls. All right, any other questions, comments? All right. I would buy either at the money or slightly out of the money, honestly. Do you think it's going higher? Because that vol's not dropping at all. That's going to be stiff, at least through the 31st. I would sell it before earnings, and then get into something hard, or sell an option. So here's how I would probably game plan Tesla if I thought it was going higher. I would probably buy like the 230 call. I would let it rally up. I'd let it rally into earnings, and then probably the day of earnings or the day before earnings. So like the earnings of the 31st, I'd probably sell it in the 30th, and then I would probably trade some sort of. If I still thought it was going to go higher, I'd sell a put spread in the weekly. That would be how I would game plan that. If I thought it was going to go higher. All right, that's not how I would do it. But if I thought it was going to go higher, that was how I would trade it. When they've got earnings, let's see what the vol's doing. Probably high. That's another one where it looks like I'm a little shocked that the vol hasn't rallied more. I mean, it's done nothing. What are the weeklies doing? 34. I can't believe how cheap this is. What is going on here? Honestly, 34 vol. I'd consider buying on an at the money strangle. I'd buy like the 202, 205, or the 205 straddle. I just think this with the implied vol is going to get bid. Doesn't a vertical spread largely cancel out your vague exposure? So selling a vertical doesn't give you as much. No, it depends how you set up the vertical spread, but typically you're still getting some short vol out of it. Not as much, but you are getting short volatility exposure for sure. I missed the last half hour. How do you determine if volatility is going up or not? It's based on kind of the mean, and it's also based on kind of where it's been and where it's coming from. All right. So, all right, let me think of all right, here's a good question. All right. This is to win a book. All right. Any more questions before I give away a book? All right. I've got a stock trading $50. How do I select straddle strikes? That is an entire presentation. I'll take boot camp and you'll learn. That question is legitimately I've got a $50 call. All right. What's 50? All right. So the strike is 50. What is the absolute most that a $50 call can trade? A strike of 50. What is the most that a call can trade? With a strike of 50. No, not the delta. What is the biggest dollar amount that it can trade without the stock moving? So the stock's trading 50, the stock is trading 50, and the strike is 50. What is the most it can trade? All right, the answer is 50. All right, the answer is 50. All right, why? Well, if the stock's trading $50 and the call is trading $51, why would you buy the call instead of just buying the stock? All right, and if the call so that's why it can never trade more than the underlying. All right, so I'm going to pick a random person that guessed 50, and they're going to win a free book. All right, so let's say Fred, you answered correctly. Shoot me an email. I'm sending you my email, and I will give you send me your address, and I will send you an autographed copy of my book, The Option Trader's Hedge Fund. My book title is The Option Trader's Hedge Fund. All right. Well, no, shoot me an email, mark@optionpit.com. So no, I said. So it will never trade over $50. There's no way. If a $50 call trade over that. Oh, yeah, no, the stock will never trade more than that. All right, trust me. Thanks, Rick. All right, does anybody have any other questions? Then I'll let you guys go. And I'm working on my next book actually right now. All right, guys. Again, go to www.optionpit.com/bootcamp and use code INSIDER to take 20% off the already ridiculously cheap bootcamp for $147. I really, it's called a business framework for trading. It's really about how to build a hedge fund business for yourself. Well, I'm glad everybody enjoyed. All right. I hope everybody has a great morning. I wish I had another hour to teach. I teach all about straddles, but I don't, and I will pass it off. I will pass it back to my my uh, co-speaker, and I hope everybody has a great day.
Okay, guys. Good morning, everybody. Let me get the questions up here. Okay, does everybody see the screen? It says holiday trade on it. Okay, good deal. Okay, I've got an hour here, guys. I'm going to try to put as much in here in this hour as I can. A little bit about myself. As I said, that I've been trading for quite a long time. I started back in 1981. I've been trading for over 30 years. I started in the agricultural business, and as I got going, I got to meet a lot of people in the agricultural business. In that side of it, elevators, processors, end users, growers, people from all over everywhere. And that's how I got in the business. A friend of mine said, with all the contacts that you've got, all the people that you know, it's why don't you come up and look what I do? I went up and I knew what they did. I went up and I got hooked, and that's how I got started in the business. And I got started in it a lot different than most people because I actually made a living trading for other people. Especially and most of it hedging. And I always thought that it'd be great to be able to go to Chicago, trade in the pits, but I had a family. I didn't want to uproot them from Tennessee. If any of y'all picked up on any type of accent, I don't know where it came from, but if had that opportunity to come up and could have gone up there several times, but I just decided, I don't think I want to live in Chicago with the winters. I'm a guy from the South, and just not something that I wanted to do. And over the years, I decided that, I'm just going to continue to do what I do. I went out on my own and stopped doing the institutional business and just traded for myself. Now, and that's something that I'd like to ask you guys. How many of you guys out there really want to trade for a living? Yeah, boy, it's rolling now. All of the questions in here, everything. Yeah, it's moving right along. I see everybody. There's a lot of people that want to trade for a living. Well, that's I wanted to be like you guys, but I kind of came in it in a different direction. I had an opportunity to learn in a different environment than you guys are learning today. Back when I started trading 30 years ago, there was no internet that I could get on and go attend a webinar or seminar. There was no really information out there other than a few books that were written. And through all of that, you had to find somebody that was willing to mentor you. I was in the office with about a dozen people and some friends, and we would sit there and kind of run ideas by each other. We talked to a lot of people, but that was the only way that we had to learn. And through all of that, we had the opportunity to share these ideas, and I started seeing the big trade that most people did back there were based on seasonalities in the market, and that's how I got involved with trading the holiday trade is looking at seasonalities in the market, and it's changed over the years quite a bit. And I had the opportunity in trading. Can you imagine what it's like when you're trading and the responsibility of someone else that you think, well, hey, if somebody gave me this amount of money, whether it be $100,000, $200,000 to trade accounts and do all that, you'd think, man, that would be great. Well, it's nice. It's not a learning ground. You better know what you're doing. But one thing that is very important, that it adds additional pressure to you. Because if you're making your livelihood for trading for other people, then you've got to be productive. And so that's how I got my start in the business. What I was trading, it wasn't my money. At the end of the day, those were days back when most commissions, I hear people talk about, well, my commissions are too high. But back in those days, commissions that average people paid, even commercial people, were in the neighborhood of $50, $60, $70 a round turn. So you can imagine what it's like when you're trading. It wasn't jump in, jump out for a couple of ticks. It was, you had to take more position trades along the way. And no matter what happened, I still got paid, but for me to grow a business, you had to be successful in what you're doing. And that's how I learned to trade. I decided, you know, I don't want to keep doing this. I would prefer to do it, trade for myself. And I went out on my own, and yeah, I've been doing that for well over 20 years now. And, you know, when I started trading for myself, things changed a little bit. It became a little more personal. Was the pressure there? Yeah, the pressure was there. And through all of this, as I started trading for myself, one key thing, overriding factor, was being able to control emotions along the way. You know, my moods would change, and all of these things. I traded all things. I traded stocks, options, futures. If it's walking around, if it's growing in the ground, if you can dig it out of the ground or suck it out of the ground, I've probably traded it. And you take all those things, and that's pretty much the extent of what I was doing. And so one of the most profitable areas that I've traded over the years has been what I've done, the holiday trade. It's been very good. And through all of that, through the holiday trade, you'll begin to see what I'm talking about. And I'll try to cover as much as I can here. And let me get started changing some of these. Okay, let me make sure my slides are changing, because it did not do it the last time. All right, guys, let me get this. Let me get my slides changing here. Okay, there we go. And of course, if you're going to be in the futures market, it's very important that you guys know that there's risk to it. I've seen people, large traders, blow out accounts. I've seen large traders make an awful lot of money. And just make sure you're aware of all the risk, that it's not something, it's not a get rich quick scheme by any means, but just make sure that you can afford to lose what you've got in here. That being the point, this is part of the, can't figure out why there we go. Now, what I'm going to start talking on, and this is the key that really got me going, this is years ago. Who's ever heard of Voice from the Tomb? Any of you guys? mic's fading in and out. I don't know if that's my end or y'all's. No one's heard of Voice from the Tomb? No, no, sorry, no. Okay, guys, Voice from the Tomb. This is a, supposedly, there was a man years ago, probably back in early 1900s, who was a grain trader. He traded wheat and corn. And over the years, you have certain types of legends that live on in the pits of the Chicago Board of Trade. And this was from the Voice from the Tomb. And people still use it today. But this is what the guy did. He made a fortune trading grains. And he had children that assumed when he finally passed away that he would get his inheritance. Well, his wife died, and his kids became pretty lazy. They were thinking they were going to pick up all the millions of dollars that he had made trading the grain markets. But one of the problems with them being so wasteful and so lazy, their father decided that he'd give all the money to charity. Well, he gave it to charity when he passed away, and this is what he left his kids. He left them the dates of when to buy and when to sell the wheat and the corn market. And he told them, he said, if you'll strictly follow the advice off of this, you'll be able to accumulate the fortunes that I did over the years that I worked. Instead of having it just drop in their laps, they had to go out and earn it on their own. Well, Voice of the Tomb, is it the question that I've got here for you guys? Is it still a viable trade setup? Yes, it is. What's changed over the years? There's been a lot that has changed over the years. You can imagine what's changed since we've been in this market for, you know, this is probably get close to 100 years old. That some of these supposed legends were first came about. Now, what's a driving force behind the dates for these trades? Well, how many of you guys out there have ever seen this movie, Trading Places? Yeah, must be a great movie, absolutely. Now, y'all remember what this was all about. Dan Aykroyd in there. He was in with, I can't remember what their names were, the two old guys, and he was the up-and-coming star. Well, in what they did, they decided that they were just going to find somebody off the street, Eddie Murphy, yeah, the Winthrops, and they were going to find somebody off the street, and they were going to teach him to trade. And the big thing that was coming on was what? If anybody remembers, it was a crop report on orange juice. Well, they waited, and if you remember frozen orange juice, yeah, and they were waiting to see what would happen with the report, and there were going to be millions of dollars that would change hands. Well, you know, that's still appropriate today. How is it appropriate? Well, we still have crop reports. Now, the key part of all of this, when I start talking about the holiday trade, is, first of all, you need to be made aware of a few different things if you're going to trade in any of the agricultural markets. And one of the ones are crop reports. If you're going to trade them, you've got to know you've got to know when it's being released, it's really not important, and this is going to be unusual. Is the information in the report necessary to trade? No, it's not. Now, if y'all have traded in the past, if y'all have seen FOMC Day, and you've seen when they come out and announce interest rate cuts in the market, and you see the market run like crazy to one direction, and then turn around and run back in the other direction. That's similar to what a crop report is. A crop report, you can have various ones. You can have what the market is going to produce. You can have in here what they expect in acres, what they expect in what's going to be used, where we're going to export grains to, if grains are going to be imported, and what effect does a crop report have on the market. Now, off of that, there are a lot of different things that can happen off of a crop report. One of the big things that has changed over the years is this: the time of day that these reports come out. Now, as these reports come out, they used to come out at 7:30 in the morning, Central Time, and all the times I mentioned will be Central Time. 7:30 in the morning, Central Time. Now they come out at 11 Central, 12 Eastern, during the trading day while the market is actually trading. So do you think that adds to the volatility of the market, would be my question, by having a major report that comes out? Right, yes, it does. It adds a lot to it. Now, if a report comes out at 12 o'clock Eastern, and immediately at 12 o'clock, the market goes nuts. It goes berserk. It starts running up 15, 20 cents. It may reverse and go down 15, 20 cents or more. Are they trading the report? Very similar to Forex stuff. No, they are not trading the report. What they're trading is what people are doing. Because there's nobody that would be able to get that report and determine, I'm going to be bullish or bearish in the midst of 5 seconds. As soon as it comes out, people start trading. And when people start trading, a lot can happen. It's called, there's a saying that algorithm trading, they've got something in there, they've kind of coined a phrase called banging the beehive. Does anybody know what that is? Banging the beehive? No. All right, banging the beehive. What that is prior to a report like this coming out, whether it's FOMC Day, whether it's crop report, whether it's a cattle report, any type of report, algorithm trading will sometimes come in and start putting massive orders above and below the market to see what they can, seek out price resistance and support, seek out people that have trades in it, and the market will run it very quick in one direction and very reverse and go back in the other direction. They'll bang the beehive, and that's where that's you can imagine what it's like if you saw a big beehive and you went up there and took a stick and hit it. What's going to happen? You better be running, because there's going to be an awful lot of activity, and that's what banging the beehive is. They create activity in the market. The algorithm traders, the computers, are very good about this. I've got a phrase that we've coined in here. It's think like a computer, trade like a pirate. And that's what we have to do. Now, off of these reports, sometimes you get some very massive price movements. Now, on June the 30th of this year, there was a crop report that came out. And this wasn't too long ago, 3 weeks ago. The importance of knowing what day and what time these crop reports are released is key if you're going to trade any of this. You've got to know what to do. Now, off of that day, look at the move that this had. A 74-cent move from the high. That's a pretty strong move in anybody's book. If you were trading the S&P, that's like a 74-point move in the S&P from high to low. I don't know if you guys would like trading that, but sometimes it can, and this is soybean. This is a soybean market. And that's what happened there. Now, so what happened? In the 4 days after that report, yes, the symbol off of that is /ZS if you're using something like Thinkorswim. If it's TradeStation, it's SX14. And this is the volatility that happened around some reports. This was back in March. This was also off of soybeans. In 4 days, we had a $4,700 move in the market. Now, off of this move, how do you trade it? What's viable off of this, off of these reports? How do you know when they're coming? Well, you can, I'll put in here as we get later on into this, and I'll show you some of the things that you can look at and make sure that you're up on this. I don't know if you've ever traded grains before, of a lot of you guys, but if you have not, it's a great market to be trading. It's never lacking for volatility in any way. There's always plenty to do. Sometimes it gets a little quiet. Other times it picks up massive moves in here that if you know how to trade it and use the right type of instruments to trade it, you can make a lot of money. I don't think anybody in here would mind picking up, let's say if you only picked up half of this and picked up a little bit over $2,200 off a trade, take a little chunk out of the middle, it would probably be a pretty nice little move. Now, how many of you guys off of this move, November soybeans, went from 12.36 down to 11.35 through, this is through the close on July the 3rd, prior to, after this report. This was what happened. How big a move is this? This is about a $5,000 move right here in soybeans. Now, was this all of it? Well, you take a look at it, and the grains are very trending. They have a tendency to hit some really strong trends, and when you catch those trends, as you see here, it's some pretty massive moves in here that you can pick up on. Now, the November soybeans, this was as of last night, closed at 10.83.5. This is that move I was showing you. This was back in, I think, early part of June, from the high that we put in at 13.50, and it went down to 10.55. This is $14,750 move. Did you catch it? That's what I'm talking about. This is in soybeans. Do I trade other things? Yes. Now, you saw what we were looking at in here off of the different markets that we were looking at. The different markets in here is not only, that's on one contract, yes. It's not only one market. Corn, soybeans, wheat, you've got soybean oil, soybean meal, you've got cattle that can be traded. If anybody has gone to the grocery store lately, you'll understand about the high cost of cattle. And if you looked at cattle right now, you'd see, the cattle we're in a massive move in the cattle market that has made some really big changes in the market. Now, what has changed over the years? If any of you guys saw anything like this years ago, you're up there in age. This is the way things used to look when people went out and when guys farmed. So you've got to think, what's changed over the last 20 years, 30 years? A lot has changed. This is what it looks like for a farmer going out and planting something in, say, in the Midwest, and the massive amount of crops that they can produce at this point. Why? Because the world's changed. And how do we take advantage of it? Now, I mentioned to you at the beginning of this that at one point, I wanted to go to Chicago and trade in the pits. Well, you can see off of this chart, off of this slide that I've got here, before 2008, on that slide, you can see what the pits looked like. And then after 2008, that's kind of what they look like now. A big majority of the time, and that's even if I had a current day picture of, say, last Friday, of yesterday, you'd see these pits even more empty. You would see some changes in here that you'd be thinking, what has gone on? It was just electric to go to Chicago and go down in the pits with guys and sit there and watch them trade and listen to them trade, and those guys had an advantage prior to 2008. There were some guys that after 2008, when the market went to electronic trading and we began to see the big majority of the volume change almost overnight from being pit traded to being screen traded electronically, that things began to change. The guy who was in the pit for all those years had an advantage. A huge advantage. There was listened to a comment about a huge S&P trader the other day. I was listening to one of his webinars that he put on. He said he knew everything that was going on. They had a license to print money down there. They could step in front of orders when they knew when someone was coming in and buying, and they were buying large amounts, and they could step in front of them and bid the market up. They could get in there and take profit and glean ticks out of the market that you couldn't do unless you were sitting there in the pit watching these guys do it. Now, along after that, what happened? The electronic trading brought in something that we never had before as screen traders. A lot of the pit traders have tried to make that transition to being a screen trader, and they've had a hard time. Why? Because they weren't able to look and get the feel off of the floor of seeing who was walking in the pits doing large amounts of orders. So the playing field has been neutralized to a degree, to a point where those who know how to trade on a computer now have the advantage over a guy in the pit, because the pit now does not have the volume to it. Now, what's different? The chart on the left there that you see, or the one with the volume on it, we never had that before. So how things change? That one thing has changed traders' edge that they've got in the market. Any trader's edge in the market, if you know how to read volume, you know how to see what's going on in the market. As you can see in here, the spikes in volume in here, and you are able to see this second-to-second basis. You see everything happening real time. As soon as it happens, boom, it's reported, because everything's happening on the screen. If you know how to read time and sales, if you can read tape, back when I first started, All we had was open, high, low, close, and last. And that's what we were looking at: open, high, low, and last. That's all we had. And we would sit there and we would watch the flow of price changes just on the screen. If it ticked from say 423 to 423 and a quarter, 423 and a half, we would watch that. And that was an advantage to me because I used to look at tape, I used to look at price changes, and you'd have to build charts in your head, but you never knew what the volume was. Now the volume is there. We've got that. Now the key is, do you know how to trade volume? Do you know how to use it? Do you know time frames to use? Do you know when to trade, what the best times to trade are? Do you know really what's going on with managed money? How many of you guys out there have ever heard of something called the commitment of traders? Now, what the commitment of traders is a report that comes out once a week, and it shows you what managed money is doing. Now, if you're trading, you should know when this report comes out. It does not come out live. It's is all the volume reported on the screen? Yes. That is electronic. Everything is reported, yes. And over, I think 85 to 90% of the volume now is done electronically. Now, the commitment of traders, back to that. Managed money. Do you want to know what's going on with the big hedge funds? Do you want to know what's going on with managed money? Well, if you know how to read the commitment of traders report, and through the webinar that we will be doing, I think it's a week from this Monday, I'll be able to show you guys exactly what all these are. Now, in short, I don't want to just spend a whole lot of time on this. Managed money in here enables you to go in and see what they are doing. You see here, this is for what is this? This is for soybeans. It shows you what their positions are long, what their positions are short, what they're doing spreading, but most importantly, it gives you this right here: changes in the commitments. You can tell the longs were beginning to get out on this was June the 10th. They were reducing some of their positions. The short position was building. What does that tell you? It tells you that through these changes that there is quite a bit that potentially you may be missing out on. Do you want to trade against the managed money all the time? No. It's much easier if you trade along with them. As you can see here that I've got highlighted that they dropped over 9,000 contracts in that week ending June the 10th. They picked up shorts of over 14,000 contracts, which means that the short side, which is the less of the two right here, is beginning to build strength. So are they beginning to change hands? Potentially, yes. The charts I showed you back there, where we saw the big move in the market, that $15,000 move, this is what happened. If I had this updated through yesterday, you would see that these numbers have changed quite a bit. And this is off a commitment of traders report. And you need to know how to use those. Now, along with this, here's corn. You've got two different areas. You've got managed money, and then you've got the producers and the merchants. Now, they will almost always have huge positions in the market because this is the way they protect themselves. They hedge the market. As you can see here, their short positions is 730,000 contracts. Now, who would be doing that? It would be a guy who is, let's say if he's growing 10,000 acres of corn, he needs to protect himself in the market. And that's where the hedging came in. That's how I got my start in the business, is dealing with these people over here. I traded lots and lots and lots of contracts all throughout the day, trying to get people neutralized in the market so where they would not have that price exposure. Because if a farmer is growing grain and he's got, let's say he's got 200,000 bushels of grain growing, he's long 200,000 bushels of corn. And every time it moves 10 or 15 cents, the value of that crop is changing. So the best way to do this is to go in and try to trade and neutralize his positions. Now, the managed money side of it, they're wanting to do what? They're wanting to make money because they're the speculators. And you can see that the short side here was building back on June the 10th. That it had increased that particular week. This comes out once a week, 26,000 contracts on the short side. The long positions were beginning to reduce their positions, not by much, but they were beginning to reduce it by 1,400 contracts. Now, through all of this, you've got to know, you pick up on these things and you begin to see that during specific seasons, there's a lot of change going on. Now, seasonalities are based on the historical trends of the market, and they've been some of the most accurate predictors of price movement. I was looking at some information yesterday that I had run across that someone had given me years ago when I first started. And it was a trend following system with some oscillators built in it. And all of this was in these days, you had to figure it all by hand. In dealing with these trends and the seasonalities, this particular guy was profitable in long-term trading 12 out of 15 years. He was one of and he was a speculator, and he was one of the more profitable guys at that time doing these trades. Now, there's a lot of things that have changed. I've talked about change and what's happened in the pit. And to speed this up a little, off of the changes that have occurred, what we've got now are international changes. Why? Because we're no longer the biggest producer in some of the crops in the world. It's expected that Russia, in any given year, Russia is going to produce more wheat than we do. When you get to South America, the soybean crops are getting huge to equal ours. So in the international markets, how do you deal with that? Well, when our crops are finished and put in grain bins, and the growers are finished in the U.S., there's another equally large crop being planted in South America. There's other equally large crops in Russia that are being planted through the different variations that you've got of the climate. We've got all types of things that are going on year-round in the grain market now. Have the trends changed? Yeah, they change. Now, what does affect? You've got supply-demand that's always going on, and how is that changing? Well, one of the ones that you'll see in the coming years, and one of the ones that has changed, has been what China is doing. Is everybody's been affected by China to some degree because of the huge population there. Look at what they are doing, where they went from a net exporter in millions of metric tons of grain, and look at 2000 to 2003, and then you begin to see a shift. Now look at what they are, net importers of grain, and that's how things have changed in here that is massive in the amount of grain that is now being imported into China. So where are they getting this? They aren't, they aren't able to meet their demand to feed people. So it's got to come from someplace. It's coming from the U.S., it's coming from South America, it comes from Brazil, it comes from Argentina, it comes from Russia, the European countries that are huge wheat growers. All of this has a big change in the market that comes about. Now, the wheat exports, global wheat exports that we see, this is what we're dealing with. You can see what Russia's doing, what these other markets have produced that they've got to do. Now, I spoke to you about at the beginning, it was called the voice of the tomb. And people ask me, well, what are the dates of the voice of the tomb? These are the dates that they had. Now, are they relevant? You may be scurrying to write all these down. Don't waste your time. Because, is it still relevant, though? Yes, it's still relevant. But like I said, things have changed. Some of these would be working extremely well. And then you would be getting your clock clean on some of the other ones. You'd have to go back, and you could go back and take these dates and run back testing off of it, and you'd see some of them have done extremely well over the years. It's a still viable thing. But as I mentioned in here on the holiday trade, this is what I call a new voice of the tomb. Why? Because you start trading the futures with a system. You start trading it with a purpose in mind. And this was something that I picked up years ago. Trading, investing is like any other pursuit. The longer you stay at it, the more technique you acquire. And anybody who thinks he knows a shortcut that will not involve sweat of the brow, sadly mistaken. Guys, I can tell you that that is really, really true. But what I'm here for, and this is something that I truly enjoy. People ask me all the time, well, why are you doing this? Why are you doing webinars? Why are you teaching? Why don't you just trade? I do that. But this keeps me sharp. This is something that I look at on a day-to-day basis. I get to have conversations with people. I get to, through our Trade the System trading room, I get to talk to people constantly, all the time. And by doing this, I have an opportunity to stay sharp. And if you think after 30 years of trading, oh, you know it, you've got everything, you should have everything. I've got a lot of knowledge. I've learned a lot over the years. Now that education cost me quite a bit. Part of my education was somewhat on a scholarship, because when I first started trading, I was trading along other seasoned traders, helping other people get crops hedged and things like that, and they were paying part of my tuition. But then when I traded on my own, you pay your own tuition, and that's when things got a little bit tough. Well, there's certain setups that I use, certain things that I use, and one of the ones is, like I said, the holiday trade. And what is the holiday trade? Why does this continue to work? How do you identify when to make these trades? That's what I'm going to be covering in the webinar that I do a week from Monday. There's so many different things you can imagine. Over 30 years of trading, there's little things that I've picked up that has helped me along the way, that there's no way I could even remotely come in and let you guys know all of this over the years that I've learned. Now, there's one thing that's going on now, and people who've been in our trading room have learned that something that I call the three sisters. And it's kind of like dogs. Dogs run in packs. geese flying formation, and grain markets sometimes trade almost identical off of moves, even though there are different things going on. Like wheat. Wheat on the Chicago Board of Trade is soft red winter wheat, and that's grown during the winter. So why does it move in unison with corn and soybeans? Because we're trading people, not markets. And that's what you've got to learn. Now, along the way, you pick up little things that may give you an opportunity to jump into a market based off of what the other two are doing. Let's say that corn and wheat are beginning to move higher and soybeans have not yet moved. You can jump in a soybean contract, long or short, moving in the same direction as corn and wheat, and sometimes pick up a very good trade off of it. If, let's say, if the market starts to drop and soybeans start dropping really quick and corn is lagging behind, a lot of times you can get in corn and then follow it down. You can pick up on these things. Now, back, what I want to show you, back in September, and this is 2011. I meant to fix this slide. 2011. It's of course September 14th, September 6th is not here. This is September the 6th of 2011, as you can see on the chart there. Now, off of this move, what we had right here, this was corn. Corn traded at a high that day of 759. And through this trading, September the 6th, what is the difference? Does anybody know what September 6th in 2011, and this is just, I went back and picked out this date. This was Labor Day. Now, you go back in a couple of days before, and you see that this high I put in the market, that it was put in here. Now, remember this, September the 6th, 2011. Let's fast forward about 30 days. October the 3rd, 2011. Now, remember this price here? 759. Now, look at the change. It closed that day at 592.5. What is that? A move of over $8,000 in 20 trading days on one contract of corn. Now, off of this, there's some things that you've got to know. You've got to know, because there can be times when you come back in off of a day where we've had a holiday, and there may be a crop report coming along behind it. There's certain entries and exits that you can use in the markets that you can get in there, and you can pick up some pretty good moves. Is everybody seeing my charts okay? Someone said they can't see the charts. Okay, everybody's okay. If you aren't seeing the charts, you may have to log out and log back on. Charts are okay, guys. So, $8,000 move in 20 days. Would that float your boat? Would that make you want to do something in here? Is follow along with that? Now, off of this, when you're looking at it, is it best to use fundamental or technical analysis for short-term trading? Now, I can trade this in two different ways. I can either make long-term trades, or either I can trade short-term trades off of these moves that you've got. There are different ways that you can enter and exit the markets that will save you a lot of money, that will be able to get in these moves and be able to stay, if you're a long-term trader, be able to stay in there and make these moves that will run for quite some time. Now, regardless of the analysis that you use to make these trading decisions, you still have to make a decision. Now, So what do you ask? Well, this is what you've got to ask. Anytime that you put any type of trade on, you've got to ask. And you've got to answer questions. If not, you don't really have a trade. You've got to come up with different questions. You've got to come up with a trading plan. You've got to come up with a system that you can trade to take advantage of all of these. You've got to ask questions. What's a time frame for your trades? Don't just haphazardly go, hey, I think it's going short. I'm going to go in here and I'm going to stick in here for 2 months, and I'm going to catch this trade, catch this move along the way. In the trading room, people have seen me go in and put on a trade and hold it for a week and pull out $5,000–6,000 off of it on one contract. I've seen some huge moves off the market, and people are sitting there and go, wow, how do you do that? Well, I cover that through all of the stuff that I teach off of the webinar, at the webinar. How much risk are you willing to assume? What's your profit target for the trades? I'll help you do these things. Now, off of this, in what we're going to be doing Monday, a week from Monday, not this coming Monday, but a week from this coming Monday, what I'd love to see you guys do is join me for a mentoring session in here. I'm going to be doing this from 8 to 10 Eastern on August the 4th. I'm going to cover all the different nuances of things that can happen in a trade, the new voice from the tomb. How to build some tactical trading strategies, knowing when these come along, knowing how to enter these markets and be able to catch these moves without risking. Usually, for me, in my trading, I don't risk more than 8 ticks out of a trade. I'll teach you how to use different type of vehicles, whether it's options, whether it's the outright futures, whether it's spreads that you use. But I'll be doing all these things, showing you how to take advantage of these holiday trades, how to set up spread charts. I had one spread chart that I was using this year, where I went long November soybeans and short July soybeans. And off of this, we had over a $5,000 move on a spread. I knew it was coming, and I showed everybody in some of the webinars that I did. I showed them exactly what was getting ready to happen, and it happened. And the reason was we traded about $15 a bushel on soybeans early this spring in the July contract, and we struggled to get above that price continually. And I said, eventually this is going to break, and when it breaks, it's going to break big. Because what was driving it was the short supply of soybeans that we had, that eventually, when we got our crop planted and it was going to be a big crop, that there was going to be a turnaround. I'll start teaching setups that you can start using the day after the webinar. This will be from 8 to 10 p.m. Eastern on Monday night. Now, what will you learn from these sessions? What you'll learn, you'll reading volume, how to identify, how to read, what the trading opportunities are by reading the volume in the market, how to look at the commitment of trader reports, using those comparisons, determine when these professional traders are reversing positions, in ways to take one contract and build one contract into whatever amount your max is to trade, and to glean bigger profits out of it. The most important rule for you to follow in these holiday trades, I'll teach you that. I'll go over all those things. Who are you trading against? And also, this is a big thing, and I haven't even shown any charts on it. It's not only in the grains. It's not only the grain markets. Now, I'll also go in there about what's driving these setups. Thinking like a computer, get you thinking in ways of, all right, managed money mostly is traded technically, and it's mostly done by computers. So if you know different areas that the computers are going to kick in, and it's very common because computers have to be programmed, and they get programmed with technical things, technical analysis setups developed by humans. And when you begin to do that, when you begin to think like a computer, then you can start trading in a way that you're going to be able to just reap some pretty big profits out of it. Identify when the best setups are and when they're most likely to occur to help you develop confidence along the way off of it. Now, you can do this. You can go to our system here at the bottom, www, or just tradethesystem.com/yes, and you can sign up for these webinars. I'd love to be able to take a lot of questions, but I know I'm going to be running short, and I'll try to pick up some of those. Now, off of this, this is what I'm going to be doing. You can also call 859-963-3445 and tell them that you want to sign up for the webinar. Off of this webinar, it's $97. You know, that's usually, you know, one trade. Guys, and it will give you a lot of information. Also, we'll follow up along with this. If you've got questions, it will do that. You know, that's not a whole lot to pay to pick up some of these things that we've got. If you could pick up a $5,000 move off the market, and I'll just show you potentially if I can get this to, let's see. Let me throw this over here. Right here. We have something coming that another big move. Look at the move this has made in here from early June down to where we are. We're seeing some things happen now that may potentially be another big move coming. And that's what I want you guys to pick up on. Yeah, that's what I want to teach. You can use Thinkorswim or TradeStation, either one. Is there an alternative date? What we'll do, we'll record this. If you can't be here Monday, we'll record it, and you can go back in and look at the recording. Do you think upside? Potentially upside move could be coming. Now, how far do you play it? That's one of the things that I'll be covering through these webinars. Why? Because this is a very bearish market that we're in right now. If you went in and looked at wheat charts, same thing. Corn, if you looked at some of the ES and the YM, I'll teach you some of the things off of those also. Would this method work for options trading? Absolutely, it would work for options trading. That's something that I'm going to show you guys. Show you the different options that you can do. And this is where is it? I mentioned to you guys about the spread. Look at this chart right here. This is August, November soybeans. This moved from $1.90 down to below 90 cents. I think this low right here was 80 cents. $1 and about, well, let me pick up what this high was exactly. 180. This was a $1 move in this spread, $5,000 move off of that spread. From when? This was June the 30th to where we are now. $5,000 move in that one contract on a spread contract off of there. I'll show you guys how to build those charts and how to do it. You don't have time to sit in a webinar, but can you get a recording? Yes, you can. You can get a recording. Now, how do you do it? Go to tradethesystem.com/yes and sign up for this. Guys, I now will try during this time. Now, the last time I said it was going to be a 2-hour webinar. It ended up being 3 hours. And the reason, because I had so many questions. I would love bonds. Yes, I'll cover even bonds through all of this. I traded used to huge. There were times when I traded a massive amount of bonds because as I went through the grain markets, I said, you know, why not go into doing some institutional trading in that. You know, banks trade bonds. I talk to people in banks all over, everywhere. Most of them were smaller banks, but I did a lot of bond trading through the years. Back when when the bond pit was just massive in the market. Now, guys, my time's running out, and but again, tradethesystem.com/yes, or call 859-963-3445. Now, if you call this number and you don't get an answer, leave a message, and Susanna will or Jared will give you a call back next week, probably Monday, and get you signed up for the webinar. But just leave a message and we'll get back with you. If you would like to send me an email, just send it to support@tradethesystem.com if you have questions. But if you want to sign up, tradethesystem.com/yes.
Basically, the 11-hour option spread strategy is a strategy that we've been doing in our valuecharts.com live trading room. I run the stocks and options room, and it's a new strategy that I've come up with. And from the results, it's one of those strategies that you can do on a consistent basis. So without any further ado, we'll just go ahead and get started. Thank you. Okay, excellent. And my sound is still good, right? Thanks, guys. Okay, all right. So again, as we're going through this, if you have any questions at all, feel free to go ahead and submit it via the GoToWebinar side menu, and I'll address it as it comes up. If I'm going to answer it later on in the presentation, I'll go ahead and answer it there. So please go right ahead and type it as you think of it, and I'll take care of everything. Okay, since I can't do my own introduction, just a little bit about me. I am a 1995 graduate of Vanderbilt University. Soon after that, I became a full broker, which is a Series 7 licensed broker, at age 23 with Merrill Lynch in central Pennsylvania. Soon after that, we moved out towards Philadelphia, and I worked for over 12 years as a senior advisor in the Vanguard Group's asset management service. My job was to handle the ultra high net worth portfolios of clients when they have a highly appreciated stock, and develop cash flow ideas. We utilize options a lot for those ideas. So we manage tax loss harvesting, things like that. So I've had a lot of time and experience with stocks and options. Again, I am the live trading room specialist, so every trading day I lead the stocks and options live trading room, and I've been doing that for 16 months, and have been very excited about the trades that we've been doing and continue to develop. All right, really quick risk disclaimer. We at Value Charts want you to know that trading or investing carries a high level of risk, and it's not suitable for everybody. So before deciding to trade, you should really consider your investment objectives, experience, and ability to tolerate risk. Now, this information can be changed at any time, and it's just provided for the sole purpose of education and helping you make your own independent investment decisions. We've done our best to guarantee that to make sure this information is as accurate as possible, but we're not liable for any use or that may directly or indirectly result in any gains or losses therewith. Any past performance results are shown for illustration and example only, and have many inherent limitations. No representation that this account will be or any account will or is likely to achieve profits or losses shown. Now, most importantly, past performance is not necessarily indicative of future results. Okay. Here's CFTC Rule 0.4.41. Basically says the same thing. They just want you to know that you should understand that there are both risks and rewards in futures and options trading. I'm not soliciting or offering to sell you or future stocks or options. And again, past performance of any trading system is not necessarily indicative of future results. All right, so let's just talk about the 11-hour option spread strategy. This is a strategy that we utilize in the live trading room, and I like to call it a bolt-on strategy. It's one of those strategies that you can do every single week. You can generate a consistent income, and it can be in addition to the other types of trading you normally do. In our live trading room, we spend about half the time trading the very first hour and a half to 2 hours with intraday trades. We have longer term credit spread strategies, and this particular strategy is something we do towards the end of the week as opportunities come up. But the topic that I will cover when I'm talking about this strategy, we're going to first talk about what I call the essential Greek of time. Those of you that have been trading options, or maybe listened to Mark earlier today, talking about the different aspects of options, the particular Greek, we call it, as respect to time. I'm going to talk about time decay and the specific use of the weekly calendar and how that comes into play and how we use that to our advantage. And then I'll show you the overall idea of the 11-hour option spread strategy. So if there's no questions, we'll just go ahead and keep moving. Okay, the first topic I want to talk about is the essential Greek of time. Now, there are the Greek factors that dictate the pricing of options. Now, these are theoretical factors. They help describe the behavior of options in relation to the underlying item, whether it be a stock or a future or an index. All of those underlying asset are controlled and helps described by the different Greeks. Now you have delta, which is dictated by price. They have gamma, you have theta, you have vega, and you have rho. Okay, the one that we're actually going to be talking to is the one that controls time. It is theta, and theta describes the options sensitivity to time until expiration. It is a geometrically accelerating decline, if that makes sense. That if you look at the, I'm going to jump ahead here so it's a little bit more clear. As you can see, that theta is the effect on the option price as we get closer to expiration. Roughly 60 days out, the slope of this line is relatively shallow. The next 30 days, it becomes steeper. You have to excuse my ability to write with this mouse. It's terrible. And then the last 30 days, you'll see how it accelerates to the point where it becomes perpendicular on the last day. So as the option ages, as it gets closer to expiration, the steepness of time decay accelerates so that it has more of an effect on price as it gets closer to expiration. That's probably the best way to describe it. Okay, and again, theta is its sensitivity to time. Okay, the bigger, the closer that the option gets to expiration, the stronger the effect theta has on the price of the option. Okay, for monthly options, those are options that have anywhere from 90 days to 60 days to 45 days. Those are longer term options, and with those monthly options, the greatest rate of loss of value to time decay is in the last month. Okay, you see it right here. The last 30 days is the strongest effect for monthly options. Okay, now there are options that are put out every week, And usually when we trade them in the last 5 to 7 days of their lifespan. And these weekly options, we see the greatest rate of loss of time, loss of premium to time decay is in the last 1 to 2 days. Okay, option sellers, use Theta to their advantage. Again, option sellers, because what we do when we sell options or option spreads, we are collecting the money, we are collecting time decay, which is working in our favor. And again, the same is true for credit spreads, is basically what I'm talking about, which is the same as selling strategies. It's just a way of selling premium that has a controlled risk. Yes, Mark. That is the question. Is this curve can be assumed that is an at the money option? That's correct. Now, if you're selling out of the money options, which is what I'm going to be talking about, the steepness of this curve is actually even more drastic. But in essence, the idea between a weekly, let me see if I can get this so it's a little bit more clear. Let's see this, 5, 4, oops, you know what? Here we go. This is better. So we have 5 days left. 4, 3, 2, 1, and again 0. Okay, you can see how the option price declines. And if we're talking about out of the money options for you more advanced options traders, this is even steeper, because out of the money options only have time value. Okay. All right, any questions on that? It really is straightforward. We just want you to understand that when options are a limited lifespan type investment, they always have an end date. They always have an expiration date. So we take advantage of that by being a seller of options. And the way we do it, we take advantage of the time decay where it is greatest. It is in the last 1 to 2 days of the lifespan of the option. Okay, so let's actually take a look at this. Again, same information that for weeklies. Again, the last 1 to 2 days is the greatest rate of loss due to time decay. And it sounds like it's a bad thing. It's actually a good thing, because if I sell you a golden ticket, and this golden ticket is every day you go to the Willy Wonka's chocolate factory, and based on that golden ticket, they'll call one name out every day. And if your ticket's called, you get in. So 5 days out, you go up there, you have really good chance to win. You don't get called. Okay, so you come back with 4 days left. Okay, you don't get called again. 3 days left, etc. 2 days left, and on the last day, the value of that ticket is going down, because you're less likely every single day to be, you have less of a chance, or less chances that that golden ticket will actually have value. So if you sold it to me on Monday, I might pay $10, but on Friday I may only pay $2 for that ticket, because I only have one chance left. It's a depreciating asset, so you want to sell it when the value of it is declining. So hopefully that kind of helps you get a more concrete feel to what an option is and how its decay helps us as a seller. Okay, again, we want to collect that time premium by being a seller. Now, what day is the best way to implement this? If we look at an actual weekly calendar, you see Monday, technically there's 4 days left, because Friday is day 0. And then we have Tuesday, Wednesday, Thursday is 1 day left, and then Friday, day 0, because it expires that day. In our trading room, we usually do credit spreads on Tuesdays. Okay, but the strategy I'm talking about today is specific for what I call the for 11-hour credit spreads, is actually implemented on Thursday. And the reason we do this on the calendar is because what we're trying to do is minimize the exposure we have by selling credit spreads, because we're kind of on the hook in case it goes against us. I mean, that's the risk we take. And then how much time to expiration. You want to optimize, you want to get as much time from the standpoint of time. You want to get as much time premium as possible, but you want to limit the actual time that the price has to move up and down against you or for you. Again, what's most important is the rate of decay. That if you optimize the rate of decay of what you just sold, that's the best and most risk efficient way of selling credit spreads. So again, Monday, Tuesday, Wednesday, Thursday, Friday, normally like to sell certain kinds of credit spreads on Tuesday, and then for our particular strategy, we want to do this on Thursday. Okay? All right, so this is how you see it on an actual calendar. Usually if we're buying weekly options, we'll do it Monday, Tuesday, Wednesday for swing trades. For a normal credit spread strategy, do it Tuesday, Wednesday, Thursday, Friday. And then here for the 11-hour option spreads, that's when we do it, Thursday into Friday. All right, any questions on time decay? The question is this type of trading meant for beginners? The information that I'm reviewing right now is a little bit basic, but it's essential to understand it in order to implement the strategy. If you don't have the background and wanted to make sure everybody's kind of all on the same level generally, for advanced traders, you know, this is the stuff we deal with every single day. So it does provide us with a background, and you know, like I said, this is not a hyper complex strategy. I think it is a very good add-on type strategy to generate additional income. What about gamma risk? Well, Carlos, without having to get into the different types of other Greeks, the gamma risk is part of it, but it really is more dictated by theta. And gamma and delta will be taken care of based on how we sell it. John, I'll be getting to that too. Yeah, actually sometimes. Just depends. All right, so let's go ahead and jump right into the strategy here. Okay, so some of the questions that have come through, you know, what kind of probability on these trades are we doing? Well, the 11-hour option spread strategy I would consider is a medium to high probability trade. We're looking historically at a rate around 80%. And when we do these in the trading room, 80% seems to be the number in which we have no trouble at all with the particular credit spreads. Now, when we do have trouble, it doesn't necessarily mean that we lose out on the strategy. Sometimes we get stopped out. Sometimes we have to do a little bit of adjusting. But most of the time, it is straightforward. Okay, so the focus of this strategy is an overnight trading focus. We want to issue the credit spreads on or about noon on Thursday or early afternoon, and then we'll hold those spreads until the 4 p.m. close. Very straightforward. And someone asked me before in the last webinar I did, why do you call it the 11-hour option strategy? Because if you go from noon on Thursday to 4 p.m. close, that's about 10.5 hours. So I thought, well, 10.5 hours is option strategy is not as catchy a name, so that's why I went with 11 hours. That's where it comes from. Now, the way we set up this strategy and how we determine our different opportunities, we utilize both the daily and the 60-minute chart. I would say that if you know how charts are, you know, you can pair them together. This is the shorter term chart, the 60-minute, and then the daily is the longer term chart where we try to get some trend direction from that. But the 60-minute chart pretty much is the is the time frame that we're utilizing here. Okay. All right, the evaluation points we use on the strategy, we're always looking at momentum. In the trading room, momentum carries a lot of weight, as does value. Value also comes into play. Another aspect is support and resistance levels based on the different time frames. Very important. And then we also use Fibonacci retracement and extension levels. I would say that is the third aspect. But again, primarily momentum and support and resistance. Fibonacci really, depending on the movement and the underlying, Fibonacci becomes important also. Our goal by trading this strategy is to achieve an income stream by being exposed overnight and into the next day. Again, it truly is an 11-hour strategy. Okay. All right. So can I just have someone tell me, give me a yes if you've sold credit spreads before, or any type of spread strategy and options. Okay, excellent. So we do have some spread traders. Yep. When you sell spreads, you have a different point of view. Now, this is just talking about how you implement it in terms of the chart. But you guys always understand, when we sell credit spreads, you're not looking for a 100% return, a 200% return. That's more of a directional trade strategy. When we sell credit spreads, we're trying to generate a consistent amount, anywhere from 5 to 10 to 15, sometimes 20%. In this particular strategy, it's a little different, but we are trying to generate a consistent percentage. Now, because if you compare our 10% goal versus a 100% goal, the reason why there's a difference is because you're trading probability for return. So what we want to do with this strategy is to minimize the risk from the standpoint that when we focus on selling credit spreads, we want to position the short strikes of our credit spreads away from the direction that we project the price will move to. Okay, so if and I'll show you on actual charts, but the most important aspect is we want to know where prices will likely not be at expiration, and at expiration, that's 11 hours. Okay, 11 hours later, where will price likely not be? That's what we want to focus on. We're not saying that, oh, okay, I think the price will be, it'll go from 100 to 105. No, all I care about is that price will not be at 90, as an example. That's what I'm trying to focus on. All right, someone asked, where did the profits come from? Pretty much from Theta. We want the value of the option credit spread that we sell to be to generate the majority of the profits. Well, pretty much it will be the profits. We're looking for the overnight decay of out-of-the-money options. Someone asked me about that. Yes, they are out of the money. Okay, we are in the trade from Thursday to Friday, and that is the time limit that we have on these. So you guys can already understand we are selling weekly options. Okay, weekly options that expire that same week. The target that we're trying to get is anywhere from 5 to 10%. Okay, that's roughly $50 to $100 per $1,000 of risk. Okay, now most people look at that and they go, oh, that's a terrible risk reward. I get that every single time I talk about this particular strategy or any type of premium selling type strategy. They'll say, oh, that risk reward is terrible. It depends on how you define risk. Now, when I define risk as $50 to $100 per 1,000, I'm talking in maximum risk out there. Okay, but the way we actually control risk is we actually put a stop on there, so that if we are generating anywhere from $50 to $100 per spread, we're going to look to risk 2 to 3 times that amount as a loss. So if I'm looking to generate $100 per 1,000, that's the credit that I received, I'll only risk a loss of $200 to $300. That's it. I'm not looking to risk 1,000, just $200 to $300. Okay. Okay, let me see if there's any questions. I'm going to answer, hopefully give you a little bit more information on that. What assets do I use to trade? Well, this is a option strategy based on individual securities, individual stocks. You can use this on ETFs, but you probably won't be able to generate this kind of return. Okay. All right, so let me make sure first that you all understand the idea of selling these credit spreads and give you an idea of how we kind of visualize how do you set it up. Okay, and now just imagine, I know this is daily, just say it's a 60-minute chart, it's fine. Google's price action comes down, we find support right here at 856. We bounce a little bit, we come back down again to 845. Now you can easily see that this is moving higher. Those of you that have been in my trading room know we call this a bullish divergence, because this is the downside momentum picture the first time, and this is the downside momentum picture the second time. Okay, what's very interesting is the move has already started. Momentum is actually green, and we are moving higher. We're making higher highs, higher lows. So which direction is Google going? You can easily see that it is going higher. So the question is, where do we sell our credit spread? In this case, it would be a bullish put credit spread, and we want to put the credit spread down in this location, below the second low, below 845.5, and that level I selected was 840. Okay, prices are moving higher. So in the course of the next 11 bars, if this is a 60-minute chart, then in the next 11 bars, prices will likely not be below 840. Okay, that's why this is a high probability type trade, because we are already, quote, profitable, so to speak, and we have both momentum and support and resistance working in our favor already. So we're saying that prices are going higher, we want to sell lower. Okay, that's what we want to do. This particular strategy, just like we do everything in our trading room, is not based on deltas. I understand the idea, and Mark was talking about delta a lot this morning. One thing that we do very well in the trading room, and I do well, is gauge price direction on the underlying. I utilize options to take advantage of that knowledge. Okay, I focus completely, probably 90% of my efforts on the underlying, and then I look to see what option vehicle can help me best take advantage of that. So this particular strategy is one of those strategies, and someone asked me before, why don't we just buy calls? We actually do that in a lot of cases. We'll pair those with directional and spread strategies, because we're making money two different ways. You can just say this particular strategy is the income side of it. Okay, all right, so again, it's based on the movement of the underlying, and we determined that the short strike is here at 840. That's really good, because it's below the 845 support level here on the second move down. So that's why we select that particular strike. Why do I use Google or GOOGL? It doesn't matter. In my trading room, I use GOOGL. I've seen people use GOOG. It's about the same. I just want the one with the highest volume. Why do I have three different colors? Oh, on my this is value charts, value bars. Basically, we apply value levels to all our different bars, and that's another part of the selection strategy. Okay. what's the distance of the long option? Oh, this is when I put these on, they're usually $5 wide. I will sell the 840 put, and I will buy the 835 put. The one thing I always tell my room, those particular factors, it depends. I've seen people do a $2.50 wide credit spread. I've seen some people do a $10 wide credit spread. The question is, for me, the most important factor is which way is the stock going, okay? So it doesn't matter if you're in the $2.50 wide spread going fast, the $5 wide spread going a little bit more slowly, or the $10 wide bus. Everybody's going north. So which direction are you going to profit from? It doesn't matter, because as long as you're in the spread the right way, it doesn't matter that the bid-ask spread. Okay, because that'll be controlled by how much you want to put at risk. It does. It can. All right, guys. Hey, Jim. You still need to send me that email. That way I'll get that to you. All right, so let's look at it from the opposite side, from the opposite view. All right, this is what we call a bearish call credit spread. So you can see CMG, which is going through the roof right now. This is a 60-minute chart. And you see, well, CMG comes up to 540, it stops. And then it comes down here to 520, and it stops. And we come up here to 550, and it stops. And then we come down here back to 520, 540, okay? Back in that, and then we break lower. Now with this break, you see momentum really falling. So which direction is momentum carrying CMG right now? Guess. Guess which way? Down. So we have support and resistance based on previous levels. Where do you want to sell your credit spread? It's a bearish call credit spread. You can be aggressive, sell it here at 540 and do 545. Or if you want to be a little bit more conservative, you can sell the 550s and buy the 555s. Okay, right there. It's working out. And this is where prices will likely not be by expiration on Friday. That's what you want to do. You want to identify that and you know, use it to your advantage. Okay. All right, so again, one last time. This is a first high, second high, okay? I'm sorry, here's the first high. Here's the momentum on the first high. Here's the second high. See how there's almost no upside momentum there? So which direction do you think it's going in? Momentum is increasing to the downside. Okay. If you don't have value charts, if you don't have our MQ momentum indicator, you can use MACD. That's a good question. You can do it to pick out. This is what we call a divergence. Okay. So where can we write the bearish call credit spread? We can sell the 190 strike and buy the 195s. Okay, $5 wide credit spread heading down. Okay, this is where prices will not likely be on Friday. Okay, so hopefully the idea behind this is pretty clear. Again, we could just go ahead and buy puts because we're falling. And somebody's going to ask me, what kind of puts would you buy? I actually trade in the money Delta 70 options. So if I think it's going to go down, I can buy the Delta 70 puts. It can be the ones expire the same day or the ones expire next week. It's okay. It's a matter of leverage to me. So we're all going down. You can buy the directionals and sell the credit spreads up there. Okay? You make money two ways. I don't know what MACD settings you would use. I mean, I don't use MACD. I use MQ momentum, but I would probably think a more standard MACD setting would be the one to use. I use primarily, when I'm doing my credit spread strategy, this 11-hour credit spread strategy, I'm using support and resistance levels primarily. I'm not looking expected calculations on how much it may move, etc. like that. I much rather look at support and resistance and see what the stock has done in the past versus saying that, oh, okay, expected move is +5, but it's below this resistance level. I don't want to do that. I want to have the comfort of support and resistance levels. Okay, and I also use the moving averages as support and resistance levels. All right, so someone asked, okay, so what kind of trades have you done most recently? This was 2 weeks ago on the 18th. These are 11-hour trades. You can see I did a 10 spread bearish call credit spread. It's $5 wide. I sold the 222.5, bought the 227.5. The credit that I received was 44 cents. So on 10 spreads, that's $440. CMG, also a bearish call credit spread. There, I sold the 595s, bought the 600s. Credit was 30 cents, was $300 profit. And then on Priceline, I did the a bearish call credit spread, sold the 1240s, bought the 1245s. That's a 25-cent spread, $250. Now, all three were successful, and that was a profit of $990 before commissions. Now, I let these expire worthless, so I didn't have to pay the second half, but that's roughly about a 6.5% return. Yes, this is done on large-scale stocks. Because you have a lot of flexibility, large price stocks, because you have a lot of flexibility in the strikes that you can select. You need how much margin do I need for each? For a $5 wide spread, it's $500 per spread. So this particular top one needed $5,000. Okay, and then so for all in all, that's how I came up with the return 6.6%. That is on 15,000 of margin. I used I generated $990. John, Thursday. If it starts going against you, that's why I identified that my stop loss is anywhere from 2 to 3 times the credit received. So if I'm looking to get $250, I'm willing to risk a $500 loss. You're like, well, that's terrible. Again, it's a percentage trade. It's a percentage trade. If this works out 80% of the time, then I'm willing to take a loss here and there. Plus, I'm also diversified. This one doesn't look like it because I have 3 bearish call credit spreads, but actually, most of the time, I'm equally balanced. Yes, I do. If it goes against me, I get stopped out. The main reason why, and some of you have already pointed this out, you don't have much time left. You have only 11 hours till they expire. All right, these are the trades I did that expired yesterday. Now, please look at the highlighted ones because it's part of a strategy we also use in our trading room. This Google trade, the 11-hour trade, we generated $350. I'm not going to go into the specifics where the short strike is. I'll show it to you. The short strike was 610, and I got a 35-cent credit. And on Tesla, we were bullish. It's a bullish put credit spread, 215. That one I only got 10 cents on, and that's a particular reason why it's that small. And then here's Priceline. We sold the 1260 call, and we generated 22 cents. I will forego a huge credit in order to have a higher probability that the trade will work out. If you're in my trading room, we debate that, as to where to put the short strikes, and I will almost always defer to take a smaller amount of credit and have more distance between the current price and the short strike. Okay, my stop loss is still the same, but I just don't like taking, I like a higher probability type trade. Okay, so with those 3 trades, that's 350 plus 100 is 450, and we have $670 additional that we earned on these trades. Now the reason why it's a little bit convoluted, it's $1,900 that I completely earned, and this one was 25K of buying power. That resulted in a 7.6% return for the whole position. Commissions are, for me, for Thinkorswim, is about $1.25 per contract. So that's $2.50 per spread times however many spreads. So you can say, you know, that's $25 per spread. Okay, that's why I actually prefer that we expire worthless. But I know there are some people with much less smaller commission rates than I have. Yes, these are iron condors, and it's this 11-hour option spread strategy actually came about in which we were pairing them with an existing Tuesday strategy, and it allows us to increase the rate of return based on different charts. How would being stopped out affect the trade? Well, it's really straightforward. I put the trade in, I get filled, I put a stop loss in at 2 to 3 times the max loss, the max profit. That's it. Oh, did I typo on Netflix? No, this is not a typo. Netflix is not a typo. I did 2 bearish call credit spreads. If you guys don't remember, Netflix fell through the floor. It just completely fell apart. So I sold this one on Tuesday. Sold this one on Thursday, or it was Monday and Wednesday. No, it's not a typo. Rick, you'll have to use your. It is pretty straightforward. I would reference your trading software. All right, so now I've showed you that, guys. I really, I bring this up to my room every once in a while. All right, so 2 weeks ago, made about 6.6%. Let's say after commissions, that's about 6. Okay, this week I made about 7.6. So let's say that's 7. So 6 and 7% over the last 2 weeks. This is a chart that I like to reference because it shows you the power of consistently bringing in profits. Okay, let's just say you started an account with $10,000. I like that. I didn't want to show 100. I just think it's more realistic, say 10. Now we do these strategies every single week, and let's just say we're conservative and maybe we only trade half of it, so we're looking to generate, and we do generate a return of 3% a week. Now with the results I just showed you, that's kind of meager, 3% a week. But after a month, that's roughly a little bit more than 12%. If you do that for 52 weeks a year, now, yes, commission, yes, taxes, yes, I'm reinvesting it. Okay, you go from 10,000 to potentially over 45,000, 46,000. Okay, I'm not going to sit here and compute to the whatever umpteenth decimal. I'm just saying, hey, we went from 10 to 40 in a year. That's pretty good. And I'm showing you a return, okay, 33%. Let's just say, hey, we have some winners, we have some losers. We go from 10 to 25. That's still in the realm of possibility. Okay? Now, remember, this is 3%. I'm showing you trades that we're earning over 5% right now. Okay? You do the math, you do the calculations. I can't promise you you're going to have that kind of return, but I'm just showing you. If you have a strategy that you can successfully and consistently implement while controlling your risk every single week, you have the opportunity to consistently grow your portfolio. Okay? That's all. What percentage of my capital do I risk per trade? That's up to you, HR. but I know some traders, they might trade only 1/3 of their portfolio or 1/2 of their portfolio. Okay, you always manage risk. Okay, so those are the numbers that's the possibility we're dealing with here. Okay, any strategy, any questions? John, you were asking about that 35,000 in margin. No, it's because the iron condor, the margin requirements on those iron condor spreads here. Oh yeah, it is 35,000. My bad. So it's going to be less than 7. Okay, because of the double here. This is 10, 15. No, it's 25. 10. 15, 20, 25. No, because the iron condors, the risk only here is 5,000. 5,000 for Tesla, and price lines of 5,000. Because at expiration, price can only be at one place. It can't be at 1,200 and simultaneously be at 1,260. That's why. Thanks for trying to double check me. All right, so let me just. There's a bunch of questions. I'll try to read the questions. Thank you. How many days until expiration? We put these on Thursday. The live for my specific live trading room, my membership is actually it's really good. I'll have to share that with you. But the platinum membership we have at Value Charts gives you access not only to my room, but the futures room, the newsletter, the member videos, the monthly newsletter, a lot of different stuff. Let's see here. Yeah, the numbers I showed you is compounded on those, that 10,000 to 46,000. Yeah, that's compounding. That's like you reinvesting your dividends. Do you ever use the same strike on both legs? No. The only time you would do that, Dan, is if you wanted it to settle right in the middle. No. I tried to find a place exactly. It was actually pretty neat on these trades yesterday. When we opened the day on Friday, we were almost exactly in the middle in Tesla and exactly in the middle of Priceline. And they didn't really move much throughout the day. So we were actually at maximum profit pretty much from the open. I do have a group of stocks that we trade every day. Again, Steve, I don't, my selection of the stock, the short strikes, is delta independent. I really don't care what the delta is on the short strike at delta 90. The one thing I'll notice, if I don't like, here's the reason why I don't specifically use delta. Okay, not is because I don't understand it or believe in it. What happens if because of the short strike and my delta is saying, oh, okay, it should be between 182 and 185 because this is a delta 20. Okay, that's what you should sell. I don't want to sell it there. Why? Do you see that my resistance level is up here at 185? So what happens if this shoots through the delta 20 and stops at 185? I've shot myself in the foot. Okay, because the stock doesn't stop because it says, oh, that's a delta 20, you got to stop there. No, the price of the stock will stop at resistance because that's where the price stopped previously. Okay, it's like trading based on a mathematical calculation versus trading based on what's actually happened in the market. Where is somebody putting it on the line? Okay, you hit this level, so all the sellers, all the buyers disappear and all the sellers start selling. That's what I want to trade on. I don't want to trade on a computation saying this is delta 20. I'm not saying it doesn't usually work, but I'm saying that's my ability to pick those and actually it's really straightforward, but it's something that you have to look at. I know a lot of options traders really look at Greeks and focus all on that. I tell you, I do it differently. I focus on the stock, and then I identify what's the best strategy to make the most of that. MQ regression. The MQ regression is a 100 period analysis. Okay, let me just see some more questions. Thursday, right around noon, sometimes before, sometimes after. That's when I put these trades on. That's why we call it the 11-hour strategy. Are my stop rules the same? Yes, John. They are. The stop rules are the same for those iron condor type trades. These trades end up as iron condors because I'm trading in the same stock, not because I want to set up an iron condor. I did have 1 week about a month ago. I had 5 iron condors, and all of them expired worthless. We took 100% profits. Cool. Yaxley, I guess the answer to your question about do I leg in separately for the iron condor? Yes, and it just happens to be it's how I pick it out. The stop is based not on the price of the underlying, but the maximum loss I'm willing to take. Now, the stop that I place, like for this particular trade, say this is the $100 profit that I'm looking to get. Well, this particular leg, I'm only willing to risk 200. Now, those of you that have traded spreads before knows that sometimes these stocks wiggle up and down. I may get stopped out. It doesn't stop me from getting back in. The reason why I did it here is because I don't want to risk max loss. I just want to risk 200. John, I've had losses before in the credit spreads, but the majority of them get stopped out. And then there are times when, and a lot of people ask me this, when I have a trade go against me, do I do adjustments? And the answer is, it depends on the chart. Is the chart going against me? Is there something on the chart that says, hey, guess what? We are not going lower. We're going to break higher. So why would I do an adjustment if I now think it's going to go up? Okay, why am I going to keep rolling this until it actually falls? Because Tesla could just continue to go higher. I much rather get stopped out, go into the next trade, than continually try to nurse this back to profitability. So there are times, like I said, this is like an 80% successful type of strategy, but again, the 80% is not based on a max loss. It's based on a 2 times to 3 times credit spread loss. That's all. Okay. And you know, if the worst thing is if you have a really bad week and this is profitable, this is profitable, this is profitable, this is profitable, and this is profitable, and let's say this one doesn't work and this one doesn't work, and they cancel each other out, is that the worst thing in the world? That you actually lose money or come out and guess what? What did we make this week? We made $0. Okay, is that bad? That's not a bad thing, and it's just part of the, hey, zero. I didn't lose anything. I didn't gain anything. I just spent some time and I learned some stuff. I think it's a really good deal. Maria, I'd have to do the calculations again. I'm not going to lose 500 a trade, Maria. If you have if my average win is 500, if that's the credit spread that I'm getting, then I'm only going to risk 1,000. Okay, so I'm only going to risk a stop loss there of 1,000. So that'll be offset by the other ones. Okay. All right. So basically, here, let me summarize what we are going to do for you. Now you kind of see the opportunity here, okay? Again, it is a self-contained strategy that actually can be expanded to different kinds of trading, but if you understand it, you can take advantage of it. It's a unique setup that's unique to weekly options on well-established stock. And what I want to teach you and I'm actually holding a workshop on Tuesday. What I want to teach you are the exact steps for implementing this strategy. Really straightforward. It's kind of a trading that, I say it here, it says make a full-time weekly profits by being in the market about 1/3 of the time. Again, you limit your risk by, how long you have your money in the market. It's only 1/3 of the time. Okay? You want to generate consistent high probability income in just 2 days a week. This type of strategy, once you set it, put your stops in, the strategy can manage itself. Now, what's different from what I've showed you today, I've showed you the idea and the essence of the trades. In the workshop, I'm going to give you the step-by-step method for identifying those optimum strike prices. Someone asked, is it based on delta, etc.? No, I'm going to show you the exact steps to go through to optimize those strikes. Then I'm going to also show you a risk control method that will help you create long-term profitability. Now, again, this particular setup is a bolt-on, add-on type strategy. If you're trading something else like futures and things like that, but you want some exposure to stocks, you can run this trade profitably every single week of the year. Well, maybe not. There's 1 week in the middle of the summer that I think everybody goes home. That's what I've noticed for years. There's like 1 week, nothing goes on, everybody's on vacation. But other than that week, you should be able to implement this strategy no problem. Now, someone asked me the other day, and I actually realized I didn't show this to anybody. What's the price of this? Value charts trading.com /go. This is, I wanted to make it really straightforward for people because this is one of those strategies that can make a difference. It's $49, folks. $49. All right. I think your commission on one trade is probably going to be more than this strategy. The main thing that I'm trying to do here is give people a strategy and an exposure to me, but a strategy that people can take advantage of in addition to what they're already doing. Okay. This is really straightforward. It's not a complicated strategy. You just want it's almost like the step-by-step formula. What's the secret sauce? How do you do it? How do you manage risk? Okay, all those kind of things that are very important. But I will show it to you in detail, and I will give you a checklist. 1, 2, 3, 4. I am doing this Tuesday, July 29th, 6 p.m. to 8 p.m. Eastern. Eastern Daylight Time. If you cannot make it, you'll still have access to it through a recording, and you always have me. But you'll have my personal email. I'll be able to walk you through it in case you have any questions. Okay, the recording will be available roughly as soon as I can get it up, probably by the next day, and you'll have full access to it. Again, I'm not asking for much, folks. This is easily a $149 course based on the profit potential. The fact that it's not some sort of strategy you have to sit there and monitor it, every time the market is open. Okay? Again, it is the 11-hour option spread strategy. You can do this once a week, and Monday, Tuesday, Wednesday, you're doing something else. And the thing about it that's nice is by end of day on Friday, you don't have to worry about it. Okay? Either you're stopped out, which is fine, that happens sometimes, or you make a profit. And you look at it and like, wow, okay, that's cool, I'm done. You don't have to worry about anything over the weekend. If you want to get into the room, let me just quick show you this. I'm sorry, there we go. You just go to valuecharts.com. I think this is the most straightforward way. You go to valuecharts.com and you go to our blog. That's where actually the recording of this will be. You see this platinum membership for $7? It'll be up in just a second right there. That is a $7 membership for 30 days for a membership that normally runs 97. And I'm just showing it to you because a lot of people are asking, how do you get involved in my trading room? And there it is. So there's the link right there. But in order to take advantage of this 11-hour option strategy, which is going to be running again July 29th, this Tuesday from 6 till 8. And basically the strategy will be just the first hour, and then we'll look at a bunch of stocks. I think we learn a lot by looking. We can identify and work through the checklist. Okay? All right, so again, I really feel that this is a tremendous opportunity, and really look forward to being able to deliver it to people, because again, for $49, this is a tremendous value. I think I'm really looking forward to being able to help a lot of people with their trading, and it gives you an opportunity to see how we trade in our trading room. Look forward to being able to deliver it. Anybody else? Let me last minute couple of questions. I don't want to run into Rob's time here. Okay, yes, I will. I can show it to you on toss. That's not a problem. Would I recommend this strategy for that has a $3,000 account? And you can do it. Yeah, the thing about it is when you write a credit spread, they don't care what stock it is, because a $5 wide credit spread is a $5 wide credit spread, and you can just do one contract. You'll be okay with that too. No, Chrissy, that's something different. This is. I just happen to throw out two different numbers. This 11-hour option spread strategy is $49. And you can register anytime. That will be up through Tuesday. It's valuechartstrading.com. Okay, it is a little different. valuechartstrading.com/go. And yes, we do. Optimally, we like those credit spreads to expire. Worthless. It's good. I like to sell somebody something and by end of day on Friday, it's not worth anything. I just keep all the premium. All right, Ezra, come to the workshop. And here's one other thing, guys. For anybody that's on the fence, if you don't like the workshop and you paid $49, let me know. I will take care of you. I'm not going to get rich on $49. I'm here to deliver great information and expose people to some great trading. That's it. Okay? That's my bottom line. If you're not happy with something, just let me know. I'm here to teach, and I enjoy it, and delivering great information. So please take advantage of that. I'm going to be quiet now because I know it's my friend Rob Booker's turn. Give me 1 second. Rob, I know you're in there, sir. Let me go ahead and make you presenter.
Hi, trader friends. I'm Rob Booker. I'm going to talk to you about counter trend trading today. And you can get more information about this system at the link that you see at the bottom of your screen right now, j.mp/trifecta-system. Today's agenda is to have a little bit of fun and talk about a complete trading system. I'll share with you the rules for a system that I use every day, as a matter of fact. And to start things off, I want to ask you what you think this is a picture of. So there we have the Hindenburg. Terrible disaster, of course. Massive explosion. That was terrible. These are pictures of my first trading account. I don't know if you have ever had a situation or an experience in your trading career, maybe early on, as I did, where things didn't really go as well as you might have hoped, and you just made a mistake. I remember early on in my trading career, I was doing really well for about 3 weeks, and then in 3 days, I lost all but 10% of my account. It was pretty bad, and I felt pretty awful about it. That was 14 years ago, and it feels like it was yesterday. Pretty bad. Second question, what kind of a trading system do you feel or do you think is depicted on this next chart? So there's a chart. This chart was shown to me by a trader in 2006 in Santa Monica when I was teaching a seminar at the Fairmont Miramar Hotel. when she pulled this chart out and she showed this to me and she asked a question. And there's a lot going on that chart. That chart is probably designed to make you want to start eating human flesh. I don't know what the purpose of that chart would be to do, but it would certainly, most likely, confuse you and turn you into a zombie or something. It's pretty rough. It's pretty rough here. This is a pretty disastrous chart, and as you can see at the top of this chart on the upper left, it says organ grinder. She sent this to me later, and this is an organ grinder chart. This is my favorite e-signal chart ever. She was an e-signal subscriber, and I just love that she renamed it at the top of the screen here after we talked about it, the organ grinder, because there was like a monkey. This is like an evil monkey at the top. At the top of the organ, you know, playing a piano or whatever. Anyway, the point is that it was a completely ridiculous chart, and she knew it. It was super busy, lots of different stuff on it, very hard to tell what was going on, and she simply needed to reduce the complexity. And I want to talk today about reducing complexity and making things a lot more simple. Nobody wants to eat any humans, least of all me. I've never had human flesh. Don't plan on it. And why then do traders like my friend there, why do they put so many indicators on their charts? Why do things become so complex, I wonder? Why do we end up placing 50 indicators on our charts? And the answer usually is because we want confirmation. We want to know that we made the right decision. Confirmation for traders is a secondary indicator, or a tertiary indicator, or a quadrilateral indicator, which is not even a word. And it's confirmation is the act of asking the market or your charts for additional information to make sure that you feel like you're doing the right thing. I had dinner with a friend last night, and I said, "Do you feel like you care what other people think?" And immediately as I was asking that question, I thought to myself, well, that's a question for traders as much as it is a question for anybody in society. Do you care about the way you look to people? What is it that you care most about, in other words? And I realized that many of the people that I know in my life, including myself at a younger age, cared a lot about what people thought. I cared about what people thought of the way I looked or the way I spoke. Or one time I went to trading expo, and I used to wear shorts. I used to dress like I normally dress at a trading expo. I dress more professionally now. But I remember somebody coming up to me and saying, "You know, this is a business conference, right?" And I just thought to myself, you know, I didn't become successful as a trader by caring what other people thought, or needing confirmation from other people, or needing validation from other people. And I've realized that over the course of 14 years of trading that I think that the best advice is free, and nobody needs a second opinion, that most of the time the simplest stuff works the best. And that's what I want to share with you today. So I want to share with you what confirmation is. This is confirmation. That's confirmation, right? That's the guy with the hat and the Gandalf cane or whatever, and the cool, like, he's got the cool mullet hat going on with the red streamers and stuff going down the back of it, and he's confirming this young boy, and with his dad that obviously drives a truck and has a sweet NASCAR mustache. Anyway, that's confirmation. That's confirmation. That's Catholic confirmation. Is, I don't even really know what it is. There's another confirmation. There's a guy, he's got a white hat on, but he's still got the Gandalf sword, and that's pretty awesome. And this young woman is moving to the next stage of her religious life, and that's awesome, and that's fantastic. But that's confirmation. Confirmation is the finalization of a process of learning about a religious belief, and then moving to the next level. It's a bar mitzvah, it's a confirmation ceremony, it's a baptism or whatever. Confirmation doesn't really have a place in trading, in my opinion. I don't think that it has a place in trading, and this is why. This is my friend in Singapore, and I got an email from him, I don't know, about a month ago, before I went to Madrid, Spain. I got an email from him, and he said that he had lost his job, and he had been making over $100,000 a year, and he had lost his job. And I'm a currency trader, although I look at the stock market as well. I'm a currency trader, and this friend of mine wrote to me, and he said, I lost my job, I didn't know how I was going to support my family, so as you can see in this email, I started a challenge. I told myself I could make $1,000 into $10,000. Now that's supposed to be heretical, right? We're not supposed to talk like that. We're not supposed to talk about and make promises, and I'm supposed to tell you, which I am going to tell you, that his results are obviously different than most people's results. Most people trade like drunken monkeys. Most people don't believe they can really be successful and are striving for confirmation or whatever else, but this is a unique situation that most people won't be able to replicate. And my friend Desmond started a challenge, told himself he could turn $1,000 into $10,000, that he would be successful and call himself a full-time trader. And like I said, he repeated some words that I'd said, everyone can be successful at trading Forex. Kind of like from Ratatouille. Everyone can cook, right? As of today, after 10 weeks, Desmond turned that $1,000 into $10,000. He says, I have to admit I didn't follow the full Trifecta rules. He changed things around and made them his own, which I love. He didn't look for me for confirmation, or he didn't hold me up in such high regard that he couldn't adjust the system for his own needs. And then he said, forever grateful, Desmond, and from Singapore. And he watches the two courses over and over again. He doesn't even spell the name of my trading system correctly, which I think is awesome. Who cares, right? So I put this up here because he had two indicators on his chart. He actually removed one of the indicators that I use, and he even simplified it further than I did. He was a better example of what I thought than I was. And here's a guy that lost his job and turned $1,000 into $10,000 and repeated the process over again. And he did it because he simplified what he did. So today I'm here to tell you about Trifecta. Trifecta is, I think it's a type of horse race bet. But one time I was in Brooklyn, New York with my grandmother and her boyfriend and my Uncle Warren, and there was a procession for the Church of Mount Carmel, and there was a procession, and then they had a holiday procession, and the priest went in the front, and they walked down the street, and there's this big statue, and they had a parade, and then everybody got drunk or whatever. And I remember my uncle was working on a trifecta bet at the horse races, and he kept saying the word trifecta. And I will never forget the sound of his voice saying trifecta in this New York accent. And that word stuck with me forever. And when I created this trading system, I named it Trifecta in honor of my Uncle Warren because it has three parts. I don't even know what the horse race, and I don't even know what a trifecta horse race is. Anyway, I'm sure it has to do with winning three things or whatever. Trifecta is a trading system with three steps. First introduced in January of 2014 and traded by about 2,000 traders worldwide. And very soon here, in the next few days, Trifecta 3 comes out, and that's about very short-term and very long-term trading with missed pivots. And it's the system I use every day, and it's the latest incarnation of that system. So that's what Trifecta is. It's just the name of a trading system that I use, and that a large family of traders all over the world are using together with me, and we love it. I'm going to teach it to you right now. I'm going to teach you the base elements of it. You can get the indicators to do everything that I talk about today, including the indicators for eSignal at TFL365.com. So all the indicators are freely available to you. They don't cost any money. You simply put in your email address, and I will send those indicators to you. At the top of the page on TFL365.com, which is my website for sending text message trade alerts, you will see links to download those indicators, and you just pop in your email address. And I will stay in touch with you by email and send you encouragement and advice, and every once in a while I'll send you information about something I'm working on that I think you might be interested in. But those indicators are absolutely free, and I think you're going to like them. I'll talk more about the indicators in just a moment. But I want you to know, as we get into this, that I have an hour to speak, by the way, and we'll look at a lot of examples of these trades, but my trading system isn't complex enough to take up an hour. Like it would take me 10 minutes to describe this trading system to you. But nobody ever does these webinars with just like 10 minutes for each speaker, because the speakers would be like, there's no way I could get through this information about the Michigan Bicycle Index in 10 minutes. But I could actually teach you this system in 5 minutes, and there wouldn't be anything else for us to talk about. But I want you to know that I don't spend a lot of time bothering you with complex trading methodologies, because I don't have any other trading methodologies. This is the only system that I use, and I like really use it. I am primarily a trader, and this is one of 2 trading accounts. This is the larger trading account, but this is one of 2 trading accounts that I run. It's not a demo account, and these trades are publicly made known to a lot of people, and these are my current open trades right now. Now, I'm a currency trader. We're going to talk about the stock market today because everything that I teach is directly applicable to both markets, and also oil, natural gas, gold, and any futures contracts you want to talk about. But I think it's important for you to know that I don't want to be rude here, but I don't just teach it. I really trade this, and I trade it with a significant account from which I make my living, and I want to tell this to you because I think that it's probably a good idea for you to follow systems that someone is actually placing large amounts of money to implement themselves. Otherwise, it's a little, I don't know, it just seems a little weird. Anyway, I'm currently short the Australian dollar, New Zealand dollar. That trade is kicking me in the crotch right now. I got in at a terrible entry. I took an early entry like a drunken monkey, and I'm eating into my, I'm slowly becoming a flesh-eating zombie waiting for this thing to turn around. It will turn around and it will be okay, but I got a terrible entry. I jumped the gun on the entry because I'm an idiot. I'm also long the euro British pound, 5 standard lots. That's $50 for every point the market moves, for those of you that are not familiar with Forex. This is just barely just creeping around break even. I'm also short the British pound Swiss franc. This is probably my favorite trade right now. I really, really love this trade. It's at gigantic highs, and the Trifecta System is basically screaming for me to sell it, and I'm holding back from selling even more. And then I'm also short the US dollar Swiss franc, and I'm waiting to sell the euro New Zealand, but I would like that to rise a little bit higher before I do. So I really trade this. It's not something I'm just here to talk to you about today. I mean, this is the only thing that I do. I think that a great trading system is repeatable, it's tough, and it's simple. I think what I mean when I say that it's repeatable, it's a system that you can depend on trade after trade. There's a lot of talk about how the markets are not volatile right now. For anybody that thinks that, I would like them to look at Amazon this week or Facebook this week, which Amazon got crushed and Facebook got sent to the moon, doubled its IPO price. Volatility is back. A repeatable trading system is a system you can depend on in markets that are low volatility and in markets that are high volatility. A tough trading system is a system that will teach you how to get out of losing trades and will teach you to toughen up, not be a wuss about the market, and teach you to face the market with confidence and be a tougher individual and have the confidence necessary to pull the trigger on all of your trades, not just when you think that there's enough confirmation. The third element of a very successful trading system or methodology is that it's simple. It's easy to implement, it's easy to understand, and it's easy to teach to your friends. Anything that's complex has a lot of moving parts. It's like a car. When your car breaks down, there are very limited numbers of people who can understand what's gone wrong, because your car is full of metal widgets and nuts and bolts and shit like that. Like, it's impossible to understand what is going on inside of your engine. My car is half electric, half gas, so it's going to electrocute me in an accident or something like that, right? So that's complex, and not very many people can build their own car, and that's why not many people do. Trading systems are very similar to this. The more complex it is, the more difficult it is to fix when it breaks. The more simple it is, the easier it is to fix when it breaks. Trifecta is enormously simple. It's easy to implement, it's easy to understand, and it's easy to teach your friends. Number 4, it's going to have a significant number of winning trades. I don't think that win percentage is the whole part of the equation. And if you are an experienced trader here, we all know, if we've been trading for a while, that you can have a high win percentage or a great risk to reward ratio, but it is very difficult to combine the two. It's not impossible, but it's very complex and it's very difficult to do that. And many people are not able to do that. What I've focused on is I have talked to traders around the world. I spoke in Madrid last month, I spoke in Tokyo last month, and I talked about this concept that if you want to be happy as a trader and you want to enjoy what you're doing, which I think is important, otherwise you're not going to want to do it anymore, is that it has a lot of winning trades, regardless of the risk to reward ratio. And there are gigantic arguments going on forums and trading expos all over the world about how the win percentage is the most important thing, or the risk to reward ratio is the most important thing, or whatever. And I think that that's a fascinating argument, but I'm just going to bring it down to reality. If you want to have giant winners and small losers, you're going to have a smaller number of trades and you're going to have a smaller number of winning trades. Your win percentage will go down because you're stretching your profit target. It's harder for the market to get you a giant profit target than it is for the market to get you a smaller profit target. So I focus a lot of times in my conversations with traders about increasing your win percentage, because when you have a high win percentage, you feel confident about taking your trade. And as you build your confidence, you can let some of your winners run more frequently. And that's kind of a strategy for success. Trifecta is a really high probability trading system. It wins 60, 70, 80% of the time. I'll show you a lot of examples today. And because it has a high win percentage, eventually you can become comfortable with how often it wins, and you can start to stretch out your profit targets. And I think that you'll be a happy person, and you'll be glad that you started off with a high percentage of winning trades. I trade this every single day, and I think it's the most enjoyable and fun thing that I've ever done. It's all based, and here we go, on daily pivots. Daily pivot points are at the center of the Trifecta trading method. I have a daily pivot point indicator available for a variety of charting platforms, including eSignal, and the indicators are free, and you can get them at that link I showed you early on, the link that I will show you again. Daily pivot points are at the center of the Trifecta trading method. This is a chart of the British pound Canadian dollar. The blue lines that you see on my chart are daily pivot points. Daily pivot points are created from the high, low, and close of the previous daily session divided by 3. So they just simply become horizontal lines drawn on the chart, and I color them blue. Daily pivots for me are always colored in blue. A missed pivot is a daily pivot that was not hit by price on the day that it was created. The chart that you're looking at right now is exactly the way that my charts look. They're simple. They don't have very many indicators on them. It's a lot of white space. And you can see I've got Spanish written here. I've spoken in Japanese and Spanish in the last month. So there might be some Japanese characters and some Spanish words on my charts, and I apologize for that. A missed pivot is a pivot that was not touched by the candles or the bars on the day that it was created, and you can see that right here. There's no candle touching the pivot. Now, I get a lot of questions like this. So if this is immediately clear to you, I apologize that I'm going to spend a moment on this. Some of you, however, haven't ever looked at this before, and you need just another moment, and I want to make sure that we bring everybody up to speed. We have enough time to make sure everybody's okay. You'll notice right here that these candles overlap, touch, or move through the blue daily pivot line. You'll notice here that at no point in time do candles touch or cross through the daily pivot line. One has been hit and the other has been missed. We don't know that a pivot is missed until the day is over. Why? Well, because it has the whole day to try to touch it. Once the day is over, however, that pivot is fixed in time. It does not change its location. It is forever in this spot. This daily pivot will forever be here. It's marked for all time and history in that space. I am particularly interested in missed pivots, or pivot perdidas, missed pivots in Spanish. I am particularly fascinated by the idea that these pivots represent a natural state, balance, home base, or an area where price desires to return. Now, once again, a pivot is yesterday's high plus yesterday's low plus yesterday's closing prices divided by 3. That's how a pivot point is created. So this pivot point right here was created from this high plus this low plus this closing price divided by 3. And then the line ended up right there. Then the line shows up at the beginning of trading on the next day, and it stays there the whole day, and price has a chance to hit it. In this instance, price does not hit it, and it becomes missed. Missed pivots are important because price always, and this is always, makes an attempt to get back to missed pivots. Now, that doesn't mean that price will get back. It means that price is making an attempt. This is really important because an attempt doesn't mean that price is going to hit those missed pivots. For example, I'm saying that price will make an attempt to go back toward this blue pivot level. It might not get all the way there, but it's going to create a situation where it makes an attempt to go there, and that can create a trade for us that can be extraordinarily high probability and make us a lot of money consistently. Whether you're trading Groupon, Amazon, Twitter, Facebook, Apple, the British pound, natural gas, crude oil, currency futures, grain futures, feeder cattle, orange juice, whatever you want to trade. Missed pivots mean something all the time. Missed pivots for me create a counter trend trading opportunity. They also create, for me, a trend trading opportunity, but we do not have time today to talk about the trend trade. It's a little bit more complex, and it takes me just a little bit longer to teach it, and it just confuses the subject. But I do trend trading as well. I just wanted to make sure you knew that I also do trend trading. Here is a chart of the euro US dollar. Now, this is probably one of the last currency-related charts that we'll look at today. But as I mentioned, it doesn't matter what you trade, these principles are universally applicable. On the left, you see a missed daily pivot circled in red, and it's a blue line. On the right, you see counter trend movement. The market was trending upward. It missed the daily pivot by not hitting it with price on the day that it was created, and then price dropped significantly following that missed pivot. Price wants to return to a missed pivot. It wants to be found, Frodo. Okay, so here's an example of Amazon. Now, most of my charts are a little bit easier to read than this, but look at all this beautiful white space on this chart. And right here in the center of this chart is a missed pivot. That daily pivot was not hit by price. As a matter of fact, this one wasn't either. Both were missed. And then Amazon dropped a ton. Amazon reported its earnings and I think let everybody know they were going to lose like $400 million over the next quarter as they try to sell 7 phones or whatever. Anyway, I love Amazon. I love the company. I just love Amazon. But Amazon got crushed. From a technical perspective or from a trifecta perspective, it's very easy to understand what happened. Amazon missed some daily pivots, and Amazon needed to correct. Period. End of story. That's it. That's the whole trifecta system principle. Missed pivots want to be found by price. They want to be touched. Now we would consider these pivots now hit because price passed through these levels. I mean, it gapped, but it still passed through those levels. The strategy that I use to trade 2 missed pivots is called the Trifecta method, and it uses Knoxville Divergence, which I made up, and I will talk to you about, Knoxville Divergence, to plan a trade in the direction of the missed pivot. Trifecta trading uses a form of divergence to plan a trade in the direction of a missed pivot. In other words, Knoxville Divergence plus a missed pivot plus a buy or a sell signal equals a trifecta trade. Now, you already know what a missed pivot is, but you don't know what Knoxville Divergence is, and I'm going to share that with you in a moment. The setup goes a little bit like this. When you are trading stocks, this is for equities. I figured a bunch of you would be equities traders, and so you would probably enjoy this. 15-minute chart. If you're a currency trader here, you would use the 60-minute chart. 15-minute chart, Knoxville Divergence, trend line or reversal tabs, which I will share with you in a moment, and that equals a trade. All right, let me talk to you a little bit about divergence for just a moment, and I'll share with you what this is all about. I'll pull up a chart here. And I'll share with you what Knoxville Divergence is. And this is all recorded, so you're not going to have a problem. Okay, this is Ballard Power Systems. I don't know what the heck Ballard Power Systems is. I don't know what this company does or anything about it. But let's just look at an example. Here's Knoxville Divergence. And get some arrows going. Okay, there's a Knoxville Divergence line. Oh, I knew that was going to be the wrong color. How did I know that? There's a Knoxville Divergence line. It's there because price was rising, but the momentum indicator set to 20 was falling. And at the same time that was happening, the RSI set to 21 went overbought. So my charts drew a line. This is an indicator that I built, and it's available for a variety of charting platforms, including eSignal. And I give the indicator away for free. You can see here that there is a Knoxville Divergence line underneath price. That is there because price was dropping, but the momentum indicator was rising, and at the same time that happened, the RSI set to 21 went oversold. Knoxville Divergence is the disagreement between price and momentum plus RSI. There's price falling, momentum rising ever so slightly, and a slight move into oversold territory. Divergence underneath price is a suggestion that price will move up. Divergence above price is a suggestion that the market will move down. That's Knoxville Divergence. Now, I don't want to plot all kinds of levels and lines and indicators on my charts. I want it to be simple. So I built an indicator to draw a line when that happens for me, so I don't have to draw lines myself. It automatically does it. It makes everything more simple. You'll also see on my charts, or on your charts when you download the indicators, some arrows or tabs colored green or red. This is what I call reversal tabs. So let's see if I can pull that up. A reversal tab is the MACD, Moving Average Convergence Divergence, plus the stochastic oscillator. Here's a reversal tab pointing down. That happened because the MACD set to 12, 26, and 9 passed through the 0 line, the midpoint line of the MACD, while the stochastic oscillator was overbought. That printed a red arrow, or a tab. That was the worst circle ever drawn. There's a circle. You can see the MACD falling through the 0 line. At the same time, the stochastic oscillator was overbought. And that creates a bearish reversal tab. A bullish reversal tab would be colored green, at least on my charts. And a bullish reversal tab is when the MACD line goes through the 0 line and the stochastic oscillator is oversold. And it suggests movement is going to go up. Okay, this presentation is recorded, and you can always go back and re-listen to those descriptions later. I don't want to plot lots of indicators on my charts, so instead I simply plot the result of those indicators automatically on my charts, and it keeps my charts very simple. On my charts, you will find missed pivots or pivots plus divergence plus reversal tabs. And I want to share with you a way to use those elements to trade stocks. I'm going to look at Amazon starting in April of this year, and I'm going to look at every example of a trifecta trade, not leaving any of them out. So there's no well-placed example. I'm not going to show you, oh, this is the greatest trade. It made $2 billion, but not show you all of what happened. So this is, if you had traded trifecta from April onward on Amazon, we'll look at that. And then we will jump over to Facebook or Twitter or something like that, and I'll just pull up some examples from those as well. You could pretty much trade this on any stock. I'll talk more about what you need to worry about in a moment. On the chart in front of you right now, you can see number one. Element number one of a trifecta trade is the existence of a missed pivot. Once you have the existence of a missed pivot, so you check the market once a day and you look for that pivot that has not been hit by price. Number two, you would then look for Knoxville Divergence underneath price. Why? Why underneath price? Because we're looking to trade back to that missed pivot, we're looking for bullish divergence. Knoxville Divergence prints a line underneath the candles and suggests that the market is ready to go. Number three, we then get a reversal tab in green that prints on the screen, and that means buy. That means buy Amazon and then hold it until we make an attempt to go back to that daily pivot. This is perfect for those of you who are interested in options. You could actually buy, I don't know why I'm writing the word options on the screen now, but now that I've started, I have to continue. So options, you could buy a weekly call, or you could sell a weekly put in this example if you want to trade options. There are ways to trade trifecta from longer term charts that use regular options, but this would be well suited for weeklies, something that expires pretty soon. Here's the next example. You can see here on the chart in front of us we have a missed pivot. Then we have divergence, number two. The red line forms. Number three, we have a trend line break. So you could use a trend line instead of a reversal tab. We don't get the reversal tab until over here. We get the trend line break up here. I'm going to suggest today that although if you are familiar with trend lines, you can use trend lines, they are more effectively used in the currency market. And in the stock market, your best signal for a trifecta trade is a reversal tab. In fact, if you had waited to sell Amazon until this reversal tab, it went from $316 a share, way lower than even $304 a share. It made an $18 move at the least within 1 day. A 1 day move after that reversal tab had been printed. So it sounds weird, but your best entry is all the way over here after price had already fallen quite significantly. It even fell further than that daily pivot. Now you might be asking, where does the stop loss go, and some other questions like that. All completely reasonable, and we'll get to your questions. Price fell as far as 287, so it went 18 plus 13. It went $31. It dropped 10% within 1.5 days. Pretty awesome. And in the act of doing that, it was missing daily pivots. So as you were profiting from the short side, it was missing pivots and creating a buy trade for you. So those pivots are missed, and we start to watch for things. Then we get Knoxville Divergence, this red line drawn underneath the candles. And then we get a reversal tab, prints, and then we buy it. And we hold on for a gain. You might be wondering, where do I put my stop loss? I would put my stop loss underneath the lows that were made when the divergence was created. Or if I were buying Amazon, I would probably just hold a trade, even if it was a loss, and wait for the next signal. Because it's Amazon, and it's going to do well over time, as will Apple, and blah, blah, blah. Anyway, that's your signal. Let's look at another example here. This is the next example of it. This is the very next, this is in May now, May 1st. I'm not skipping any examples. You'll be able to go through your own charts and see for yourself as well, which I would encourage you to do. Always verify whatever you learn. Number one, we get some missed pivots as price is rising. So this is the buy trade we were just talking about. So we bought it and price was rising and it started missing pivots. So it misses these two daily pivots and then we get bearish divergence. Number three, how do we sell it? Well, I guess we could sell it based on a trend line break. Like we could draw a trend line underneath this price. But there really was no reversal tab, that red looking reversal tab lower. And in this case, I would probably skip the trade. Price falls after what I just told you. And what happens is we start missing pivots. You can see how this system just goes back and forth in a non-volatile market, so to speak. It's the greatest thing ever. We miss a pivot. And then we get bullish Knoxville Divergence. And then we get a reversal tab. So we buy it. Now price drops lower than the lows that were made. And like I said, in a buy trade, I would generally hang on to this. I would generally hang on to this trade because it's Amazon. It's a technology stock, and it's going to do well over time, and I like the fundamentals and whatever else. So I really wouldn't worry about the stop loss in this instance. I might hold open the trade longer than that stop loss. It calls our attention to trading options, for example. If I were to buy a weekly call right here with a strike price halfway the distance to that pivot, I would probably do quite well. Or if I were going to sell a put and make some premium, I could probably do that pretty nicely. You could also do spreads as well if you want to. And then price moves up and it moves all the way to that daily pivot. Price moves up as we talked about that it would do, and on the way to moving up it misses a daily pivot. Number one, right there. Number two, it creates divergence. Number three, it prints a reversal tab and then it drops. It's another example. Here's another example. Price. So this is the trade we just did right here. It missed this, it went up and then it came down, and then when it came down it missed this pivot. I love this trading system. And then what happened next? It printed a reversal tab, but no divergence. For those of you that are familiar with Trifecta already, there have got to be some of you here, you'll notice that something's missing, and it's the divergence. And on stocks, you don't really need the divergence, but you do need the reversal tab. So in this instance here, we could go ahead and buy Amazon or buy a weekly call or sell a weekly put even without the existence of that divergence. This is what happens next. It runs up a ton. We get a huge run up in Amazon, and no surprise, as it's running up, it misses a daily pivot. Then we get divergence. That's the second element. And then number three, we print a reversal tab all the way at the top, and then we make a drop. Now this time it doesn't go as far down as this daily pivot. It's the first example in all of these where we do not hit the daily pivot. It just doesn't happen. But if we were trading, if we bought a weekly put, that's going to increase in value immediately within just a day or so. That's why options are so powerful here. You can make money even if it doesn't get all the way to the target. Here is an example. This is the very next example. It rises back up again, and it misses a daily pivot on the move on the way up. Then it prints divergence, and then it prints a reversal tab, and we're selling it. So if we're going to sell Amazon short, short selling Amazon sounds like a terrible idea, doesn't it? So I would more likely than not buy a put on Amazon and see if I could give it a week. Remember, this is Monday, this is Friday, and I would give it a week to drop, which is exactly what it does. So an option here is a very effective strategy. If you sold it short, you would still be okay in it, but selling a technology stock like this might drive you nuts. Or if you want to, you could sell it and then just stop out above the highs and just move on with your life. Stop out, don't worry about it. But I would use an option. Over here on the left, you can see This is the trade we just talked about, so we don't need to look at this. We just talked about that. But when it dropped, no surprise, it misses a pivot. So one trade that you're in starts to create another trade that you're going to be in next. So awesome. Anyway, then number 2, it prints divergence. And number 3, it prints a bullish reversal tab. You buy it, and price moves up. Misses the pivot here. The signal comes on a Monday. And by Friday, well, by Thursday, it's already jumped upward. So if you bought a call or if you sold a put, you're going to make money. So there's another example. And then this is done. We just did this. And then it drops back down and misses a pivot again. And then there's no divergence here, but we do get a reversal tab. So there's no step 2. We skipped right to step 3. We get a reversal tab. And then we buy Amazon. We buy a call or sell a put. And on Monday we do that. And by Tuesday morning, we've already risen and gotten within just a few dollars of the missed pivot. Here's number 3. It rises upward. We miss 2 daily pivots in a row. We get divergence, and then there's no number 3. There's no reversal tab. Now you could draw a trend line here and trade below that trend line, but I would generally skip this trade. In general, I would just skip the trade and not worry about it. All right, this is the next example. Price is falling. And we knew it was going to fall, but we just didn't have a trade. Price is falling, misses a daily pivot, creates divergence, creates a reversal tab. We buy it, and it shoots upward. That was a huge trade. It even gaps upward, all within the week. Weekly options, or just buy it for the week or whatever. Shoots upward. Well, of course, if it's going to shoot upward, it's going to miss daily pivots as it goes upward. And here's what happens. It misses daily pivots as it goes up, and then it prints a reversal tab. If we sold it here, we're not going to make money. The option that we bought is going to expire worthless. If you're an options trader, you could roll that over and trade it again the next week after. But this is the first example, because the markets are becoming more volatile. This is the present day. This is the first example that we've seen that's just been a total disaster. It didn't work. I mean, it stops out. And it doesn't even, it makes no attempt from the time that we got in the trade, it makes no attempt that week to get down to either of those pivots. But later on, it prints another bearish divergence and another reversal tab. So there's a second entry. Now, if you're an options trader, you roll this thing over and you just do it again. Or you add to your trade, or this one expires worthless, and then you get another one. And I would go 2 times the size on the second trade. And then Amazon reported its earnings, and this is the present day, and we got a signal before earnings. And there's no question I would trade it. There's absolutely no question I would have zero problem trading that, especially if it was an option. I don't think I'd sell Amazon short and just sit in the trade right before earnings, but I would buy a put or sell a call. I would do that, especially if it was a spread and my losses were capped and my gains were capped. I would definitely do that. All right, remember, price will make an attempt to return to the pivot. That's not a guarantee that price is going to get all the way to the pivot. It will not necessarily make it all the way back to the pivot point. All right, let's look at some examples from Facebook and Twitter. I've pulled this up, but I haven't looked at this in a few days or anything like that. This is Facebook. This is May. I don't care where we go on the charts. It can be random. I'm not trying to trick you or anything like that. I mean, the webinar is free, so I'm definitely not trying to trick you. But I want to show you that it works. Facebook misses 2 daily pivots here in May. It prints a reversal tab, and it prints the divergences that we need, and then Facebook makes an attempt to move down from there. Let's see, the next missed pivot is, this one is not missed. You can see a tiny little portion of a candle hits it there. The next missed pivot is right here on June 10th. We print divergence, a reversal tab, price moves down. Let's look for the next missed pivot. Next missed pivot comes June 24th, and then a reversal tab happens. Well, that reversal tab happens before the day is over, so that doesn't count. This one does count, however, and it's missing this daily pivot in the act. So this is a sell trade. Stop loss could go above this level, and it prints multiple reversal tabs. Hence the power of options. This one would expire worthless unless your expiration was the next week, which would be fantastic. And then you have 2 more opportunities to trade it, and then price does fall significantly. It's going to miss a pivot on the way down, which it does. Misses this pivot on the way down, prints a reversal tab afterwards. It does have divergence right here. It doesn't have divergence over here. That's fine. You buy it. Price makes a nice attempt before the end of the week to jump upward. Then, of course, as it jumps upward, it misses 2 daily pivots in a row. 2 daily pivots in a row is often indicative of a market that is going to strongly trend and could be a little bit dangerous to trade. Let's just trade it anyway, and we'll sell it on this reversal tab. And it makes an attempt, but not a very good one, to go down, and it eventually, that option is going to expire worthless, or that trade is going to stop out. Then you get a missed daily pivot just on the 21st of July, and then you get a reversal tab, and that option is going to expire worthless. Did expire worthless, and then Facebook prints another reversal tab right here. And it's harder to sell these technology stocks than it is to buy them for obvious reasons. We're in a bull market for technology. But it still works. You can still see lots of examples. Twitter's another example. I love the Web 2.0. I love the technology 2.0 stocks. There's a missed pivot, a reversal tab, an attempt to go upward. Here's another missed. Oh, did I miss one? Yeah. And then here's a missed pivot. Here's a reversal tab, and there's a sell opportunity. And then here's a missed pivot. Here's a reversal tab buy, and that is a nice opportunity. Followed by a missed pivot here, a reversal tab, and then last week we couldn't get down there. And then earnings. I don't know anything about Twitter's earnings, so I'm not familiar. I wouldn't be surprised if this was just a gigantic winner. I mean, like a huge, not a winner for this trade, that it's just going to go up now and create more missed pivots. The question might arise, do you need divergence at all? The answer is no. With stocks, you don't need it. With the currency market, you do. That's why we talked about it. And let's go back to the slide. If you go to TFL365.com, on the home page, you will see arrows that say, get the Knoxville indicator free, get the missed pivots indicator free. You can get more information about trading Trifecta at the link on the screen in front of you, j.mp/trifecta-system. I'll give you a moment to write that down. You can find me on Facebook at Robbie Booker. It's a Facebook page. Don't be offended if I don't friend you on Facebook. I'm only friends with my sister and my dad and my family members on Facebook. So it's just a real personal thing. But I do communicate with traders all the time through the Facebook page at Robbie Booker. Or you can find me on Twitter if you want, at Rob Booker, and I would be happy to answer questions or talk to you, especially on Facebook. If you go to Facebook and like the page and ask me a question in the comments section about what you've learned today, I get on there and I'm happy to answer questions there. That's a really good place to ask me a question. And you can do that right within any of the recent posts about Trifecta. So you can get in on all that action right there. And Trifecta's got all kinds of stuff about short-term trading that we really don't have time for today. But I want to thank the Value Charts folks and eSignal for sponsoring us. And I really appreciate the time that we've had here today. I look forward to talking to you in the future. I'm happy that we got a chance to chat about trading today. I hope you like the Trifecta system. I hope it works for you. I appreciate you taking time out of your day to join me.
Okay, hopefully that'll make my sound a little bit better. Well, thank you everybody for attending our presentation today. What we're going to talk about today is kind of a combination of things that I've learned over the years. First and foremost, when it comes to trading, we need a strategy concept, something that's going to give us an idea of market direction. Okay, something we can use to know if we should be bullish, bearish, neutral, some sort of direction and concept from where we're going next. Now, after that, it really comes down to how do you want to take advantage of the opportunity. Now, I've been trading for 17 years. The first probably 10 years of my trading career all focused around futures, where I was doing a lot of day trading of the E-minis. I would be trading the euro. I was trading really any futures that I could get my hands on. And one of the things that I never really traded in the first 10 years, I never really did options. And it all stems from my career as an educator. I've taught thousands of traders all over the world. And I was sitting down at a seminar at lunch, and this is from the advanced get side, the Elliot wave side. And I was teaching a class on trading, and I had one of our users come up to me and say, you know, Ron, I've been trading with advanced get now for almost a year, and I have lost over $100,000. I was taken back. Now, at the end of the day, there's no guarantee that you're going to make money as a trader. There's no guarantee I can make you. But I was taken back because this guy had lost money. He was still coming to the seminars, and it's my job to figure out what went wrong. So I'm sitting there talking to him, and he said, you know, one thing I've learned, he's like, first off, I don't blame you. Like, well, if it's my software, you got to blame me. But he said, it's not the software. I'm seeing these trades develop on the chart. I'm seeing these pristine Elliott patterns that you talk about. I put the trade on, the market moves my direction, and I don't make any money. Well, immediately I'm taken aback. How can the market be moving your direction and you not make money on this thing? Now, keep in mind, I'm a futures guy. If I see the E-mini going up on a 5-minute chart and I buy it, and I get in at 1300 and I get out at 1305, I just made $250 a contract, right? 5 points, and I'm in. How can this happen? Well, come to find out, he was trading options. Now, that scared me. All I think about now is, boy, I can be right on the trade and I can be wrong on the money because I got the option strategy incorrect. That scared me from options for a long time. Well, one of my mentors in trading, Tom Joseph, who actually wrote the Advanced Get System and who I still work for today, really introduced me to the concept of good options trading probably about 8 years ago. And what I've done with that options knowledge I have now that I'm going to share with you, and I know today a lot of today's presentations were also some options knowledge, so you got a really good background in this stuff now. What I've learned over the years is to keep using this Elliott stuff that I'm doing. And then what I want to do today is I want to show you how you can take these Elliott patterns that you're going to work with using Advanced Get and how we can take those and develop them into a very good option play. Now, I'm talking option plays that are high probability trades, 75, 80, 90% accuracy. Now, I know that's pretty hard to believe, but this is based on historic volatility and the volatility of the options markets. If the market goes in your direction, you're going to be profitable. Now, the beauty of these options plays are if the market doesn't go in your direction, I'm still going to show you how you can be profitable. And that's the key. We're going to bank on the side of the Elliott wave. We're going to let Elliott derive our direction. And we're going to take an option play like a bull call, or I'm sorry, a bull put or a bear call spread. We're going to do credit spreads. I'm going to show you how to set those trades up that give you such a margin for error that even if the market doesn't go your way, most of the time, you're still going to be left with profits on the trade. It really is a beautiful thing once it's all said and done. Now, I'm going to use 2 software platforms to accomplish this. I'm going to use eSignal 12 with the Advanced Get add-ons. That's going to help me derive my Elliott patterns and my trading opportunities. And I'm also going to use eSignal's new options program called Options Analytics. And I'll show you how I go back and forth kind of setting those trading concepts up. And I'll show you the keys of every one of those. All right, now if you have any questions throughout the presentation, don't by any means hesitate to ask me in the chat. And then towards the end, I'll kind of wrap it all up and show you how everything kind of works together. All right, let me just do one more thing here real quick. I want to change my screen around so I can see it a little bit better. All right, first things first, let's talk, before we get into the strategies, before we get into, options and all that stuff, let's talk about markets. What you're seeing in front of you is a daily chart of UHS, Universal Health Services. Now, they gapped yesterday. I'm going to assume there was news, earnings, whatever. I don't really care about the movement so much in this chart as I want to explain to you the process of trading this, all right? Now, the first thing that I always like to tell a trader, the first thing that you got to wrap your kind of head around as a trader. It's not always about looking at the chart and getting the big move. Now, when all is said and done, 3 months down the line, if you want to work with me and you want to work with Advanced Get and you want to work through all the systems, I can show you how to get a piece of every move. I really can. But when we only have an hour, we got to really focus on high probability areas. Now, when you look at a chart like UHS, okay, and I was to ask an average trader, hey, where do you want to be on this chart? Where do you want to be long? Where do you want to be short? The first thing that they're going to point out, I would hope anyway, is you're going to say, wow, look at that move right there. That's where I want to take advantage of it. I just drew an arrow on it. It might be a little delayed depending on internet connection, but that big move that we had from about 72 bucks all the way up to about 100, that's where you want to be in this trade, because you know what? That's the power right there. That's the big move. In trading and in life, ultimately, everything has a pro and a con. Now, when you look at a chart and you say, oh man, look at that powerful move, chances are that move, like this one, is set up by a trend breakout. The market's breaking out into a trend. And for you to take advantage of that, you have to trade a trend breakout system. Trend breakout systems, by default, in all the ones that I've ever tested, are typically lower percentage of accuracy, but they have a much higher reward level. Okay? You're going to make more money, but you're going to be wrong a lot more times. There's nothing wrong with that. The downside is, not a lot of good options plays that are high probability in these types of areas. So that move right there is the good-looking move, but it's not the high percentage move. Now, when I'm a trader and when I'm trading for my real money, what I want is I want high percentage moves with high percentage options plays behind them. Okay? My goal in life and my goal in trading is to be that, second baseman playing baseball that I'm hitting for 360. Maybe I only hit 5 home runs a year, but I got good defensive moves and I'm hitting 360 on the year. I'm the good offensive player. I'm not the guy hitting 65 home runs that bats 215. When it comes to trading, I'm okay with lots of singles, some doubles, occasional triples, and every now and then a home run. I want the high percentage moves. Now, when it comes to Elliott wave theory, concepts, and the most important thing about Elliott wave, practical trading. From a practical trading side, there are 2 moves of Elliott wave that all of our research has shown us to be the most effective and highly probable patterns to trade. Pattern number 1 revolves around Elliott wave 4. Pattern number 2 revolves around this Elliott wave 5. Now, if you're not familiar with Elliott, let me give you a little bit of a primer on how Elliott wave works. Now, for those of you that are familiar with Elliott, you've probably read 1,000 books on it. You're going to know that I'm kind of leaving some things out here because we only have an hour, so I can't, teach the whole thing in an hour. The main general theorem of Elliott wave is this. Elliott wave is the theory that a market trend happens in 5 waves or 5 legs. Okay, we call them waves because it's the Elliott wave theory. 1, 2, 3, 4, and 5. After a 5th wave, the market tends to reverse. Now that reverse can be a complete change in trend, or it can be just a major move. A 62% retracement of the trend followed by a congestion period. But either way, a high percentage of the time, after you see a normal 5-wave pattern, you will either see a major change in trend, or you will see a market sell-off, or a market rally if the 5 waves are going down. This is directional. It can be going up, it can be going down. Now, what Tom Joseph did back in the late 70s, early 80s, when computers were just starting to be born, so to speak, home-based computers, he did a lot of tearing apart and a lot of research into Elliott wave theory. And what he found was that, sure, I can give you Fibonacci levels, I can show you Gann levels that'll help you track wave 1 and wave 2 and things like that and seeing how they're built. But if you're looking for high percentage of predictability, the waves 3, 4, and 5 are really your best bets to trade. Now, this circles back around to the logic of, as a trader, you have to be comfortable with understanding you're not going to be able to predict every single market move. Okay, you just can't. There's too many market moves. There's too many factors at play in market behavior. You're not going to be able to, project and trade every single market move. So right away, as a trader, you really want to focus on what can I predict with a good degree of accuracy the most times. Well, in the Elliot theory, according to our research and what's shown us in the past, and quite frankly, practical trading, the 3s, the 4s, and the 5s are the most predictable sequences. Now, in saying that, if you put on a chart using E-Signals Advanced Get, using our Elliot concepts, you will never see an Elliott wave 1 or an Elliott wave 2 in real time, because our Elliot is built on the premises that you cannot accurately predict waves 1 and 2 in real time. Those are after the fact wave counts. The only thing that you can project with a great deal of accuracy is 3s, 4s, and 5s. Now, I'll kind of go in a little bit more too. There's also an ABC corrective pattern. If you remember, I talked about the general theory is 5 waves up, 5 waves down. Well, remember how I said that after a 5-wave pattern, the market tends to have a new downtrend or a new trend in the opposite direction? Typically, that would be another 1, 2, 3, 4, 5. Well, sometimes that doesn't happen. You get a correction. That usually happens to be an ABC. It's a truncated or an abbreviated 5-wave sequence. So in our software, when you pull up a chart, we are going to put you into a trading sequence, a 3, 4, 5, or if we can't find a 3, 4, 5 and we can't get it in there, a C. All of our strategies are based around 3, 4, and 5. Wave 3, like you see here on UHS, that nice big high, that big dollar move. If you can see the colors of the bars, you'll notice that some of them are black, some of them are blue, some of them are red. That's one of our indicators that we created that works along with Elliott counts, called the XTL, Expert Trend Locator. When the software tells you that the market's in a wave 3, we look for the bars to be blue or red to confirm the trend. Okay? That's one of the ways that we'll get a hold of that XTL sequence. Wave 3, the bars turn blue, confirms it, boom, it's a trend. And then we have a system along with that that'll, keep a trailing stop. It's got a trigger technique to verify that it's truly a trend breakout, that sort of thing. Okay? And those are good. Those are good trading strategies. But what I want to focus on now is the high percentage stuff. And that really revolves around 4. So the general concept of this is, from a trading perspective, if you look at UHS, I want to try ultimately to get you long UHS somewhere in this area right here. This is the breakout of wave 3. All right? Once that wave 3 top is in place, now how do we know when this wave 3 top is in place? How do we know what Elliott wave we're in? That goes back to the Fibonacci core of how Elliott's constructed. If you measure the distance of wave 1, you can get an idea of where wave 3 will stop. If wave 1 and wave 1, I know that it's sometimes a little bit delayed here. If you measure wave 1, okay, and wave 1 is $10, historically speaking, your wave 3 will be $16 to $26. It's a 160 to 260% extension of Elliott wave 1. We can measure this using our Fibonacci extension tool. So I'll measure from the beginning of wave 1 to the end of wave 1, and I'll put that measurement to where wave 2 is labeled, and you can see that this one came in a little bit short. We were anticipating about 102 for the end of wave 3, came in at around 99.50. So it kind of came in just a little short of the most times of where wave 3 terminates. All right. Now again, from that wave 3 perspective, I'm not going to talk much about trading that area, because what our conversation today is about is the high percentage stuff. But I want to bring this in because it kind of works into what I'm going to show you next. When that wave 3 is in place, okay, and I'm going to put our chart into replay mode so you can kind of go back and see what it looks like at the time. Right here is wave 3. Okay, this is what UHS looked like on June 23rd of this year. It's a wave 3. Now, we're expecting that market to get up to about 102.15. But hey, projections are projections, fib levels are fib levels. Worst case scenario, if you're trading this thing and you're long, I would kind of be hoping that you would be tracking this thing with some sort of trailing stop. And right about there, you're probably getting out of it anyway. Okay? Now, this is where, from the trading side of it, you really need to be a pilot. Trust your instruments. Because what happens next from an Elliott wave perspective? We're at a 3. We think the 3 is probably reaching its conclusion point because we're up there around 160. Okay, we didn't quite get there, but we're up around 160. The market has broken through a trend line now. Okay, what we know is next from an Elliott perspective is we think that this market's going to sell off into a wave 4 and re-rally back into a wave 5. That's my projected sequence next. A wave 4 retracement, so we're going to sell this thing off maybe down to $84, maybe down to $90. It's going to stabilize, and then it's going to rally back in. Now, as a greedy person, which we're all greedy at the end of the day, it's okay. Greed sometimes is good. You know, remember the old adage, pigs get slaughtered. So do sheep, too, by the way. They all get slaughtered at the end of the day, right? So pigs and sheep, they both get slaughtered. What you want to do, typically on this, and I've seen this over and over again, what I tell people is this market's probably going to retrace and then re-rally back up to a 5th wave. What the average trader wants to do is say, well, then why do I want to get out of this thing? I want to stay in it. There's no reason to get out of it. Nothing is guaranteed, okay? Yes, this market should come down to a wave 4. It should stop. It should rally back into a 5th wave. But we don't just operate under the assumption that that's going to happen every time. This market is entering into what Elliot calls a profit-taking retracement, okay? Profit-taking retracements mean you are to take profits. That means get out. I don't want you trading in this area. If you're long, get out. Stop trading. Take your profits and move on. The market is now moving against you. The market's coming down to a 4th wave. Now, I want you to think about it like this, right? Let's say that you were a little bit late into this trend and you bought into, you know, UHS at 84 bucks, which is right about here, okay? You bought into UHS on this breakout sequence at $84. Well, the typical wave 4 can retrace all the way down to 62%. If that happens, you bought this thing at 84 bucks, this market comes down to 88. You just left $12 on the table, and guess what? There's no guarantee that it's going to stop at 88. This market may continue selling off and just never recover, and boom, you lost. You know, you got long at 84. This market basically went to 100. You left $16 in profits on the table, all because you thought it was going to re-rally. You don't do that. When wave 3 is complete, or it's near completion, there's 2 ways really. Well, let's just be blunt. The bottom line is there's one way to determine when wave 3 is over. That's when wave 4 comes in. Okay? That's the main way of determining if 3 is over. But there's going to be some clues. Clue number 1 is we're up near that Fibonacci level of 160%. Clue number 2, you know, use a trend line. Use a regression trend channel. Use the displaced moving average. You know what? In the software, another really good study that's easy to use is called a parabolic. If you ever used a parabolic indicator, okay? A parabolic is designed to be a trailing stop. When that market starts getting choppy, you know, you can kind of see the lines. Well, let me just verify here in a second. Okay, you see these little blue stars underneath the market? This is a trailing stop concept. So when that trailing stop reverses like it does right here at around $94, that's a clue that wave 3 might be complete. Now, at the end of the day, it wasn't. It still went up another $6 or $7, and that's fine. It's not about capturing every little penny. It's about being percentage. So when this thing starts going back and forth up here, just get out of it. As the market starts coming back down, it's going to give you another opportunity. Okay? Right here is where Elliott wave 4 comes in for the first time. Right here. Now what I want you to do as soon as this number 4 pops up on the screen is I want you to start thinking, now it's time to rebuy back into this market. Okay? The wave 4 profit taking phase is confirmed. Now I got to start thinking, get long UHS. Now, a couple cardinal rules of going long a market or going short a market. You do not buy a market on bearish days. You do not sell a market on bullish days. All right? If you're looking to go short a stock, doesn't matter what stock it is, it's typically not a good idea to buy a market when the market's down. You don't buy against it. You buy it with it. You wait till that market stops going down and starts coming back up. Now, this sequence right here I'm showing you on UHS, this is one of the highest percentage trades of Elliott wave. This can be a good 60% directional pattern. With options, I can even get it higher than that. Okay, I can make money on this trade a lot more percentage of the times, and I'll show you how here as we get into the options portion of this. Right now, we're just working on direction. I want to get direction nailed down, and then we'll work on the actual play of it as we go a little bit farther forward. Right here, when that market's in a wave 4, you got to be thinking about buying into this trend. The market's in an uptrend, wave 4 is in, you got to be thinking about buying. Now, this sequence that you see right here on the screen, this is what we in advance get called the Elliott Type 1 trade. Okay, the Elliott Type 1 trade. There's 4 rules. Now, the Type 1 trade is what we call a mechanical trading system. That means there are 4 rules that you follow every single time without exception. If one of these rules are not in, you don't take the trade. Simple as that. Rule number 1, you have to have an Elliott wave 4. Now, through the use of replay mode, this, by the way, again, this is UHS back around July 10th. I can go back a couple of bars. This right here is not a Type 1 trade. There's no wave 4. If there's no wave 4 visible, it's not a Type 1 trade. All right, I take the next day, boom. Now it's a Type 1 trade. It's a wave 4. That's rule number 1. Now, rule number 2 is one of the most important things that you'll ever learn about trading Elliott wave and advanced get. It involves this study on the bottom of the chart. It's called an oscillator, a price oscillator. Since we use, an oscillator that kind of syncs up to Elliott, we call it the advanced get Elliott oscillator. Now, the Elliott oscillator is nothing more than a histogram of 2 simple moving averages, a 5-period moving average and a 35-period moving average. Now, to keep the rules simple for the demonstration today, what I typically want to see, essentially, is during this wave 4, I want to see the moving averages cross. Okay, a 5-period and a 35-period moving average. When those 2 moving averages cross each other, what will happen is you'll see down here towards the bottom. Let me pull up my drawing tools and I'll throw an arrow there. You see how every time the oscillator kind of rotates, this is the axis or the 0 line. Every time the oscillator does this kind of thing, it rotates from negative to positive. This is where those 2 moving averages, a 5 and a 35, either touch or cross. In the majority of wave 4s, that oscillator will touch or cross, okay, the moving averages. Now, a couple of the questions, let me check the questions real quick here, I don't see any. The question that I get here a lot is, well, isn't that just a MACD? No, it's not a MACD, it's close. MACDs and oscillators like this have very common characteristics. They're both moving average based. Typically your MACD is based off an exponential with a smoothing moving average to kind of even it out. The price oscillator, the 535 oscillator that we show you in advanced get, it's actually simpler, more simple than a MACD. It's just 2 simple moving averages, a 5 and a 35. Now the second question I get is, well, why didn't you just use a MACD? Well, if the MACD would have been more effective, we would have used a MACD. It's not about trying to curve fit an indicator to the data using a MACD. It's about what works. Over history, this oscillator has shown to be very effective at marking and plotting successful wave patterns. So it's not about we sat and came up with this brand new indicator that everybody in the world, it's very proprietary, nobody can use it. It's an oscillator. It's a 535 oscillator. We use it because it's effective. You can go into pretty much any trading platform and do an oscillator. You could use this oscillator in your system now, a 535. You don't need advanced get to do it. Now for the wave 4 and some of the other things I'm going to show you, of course, you will, but the oscillator itself is just an oscillator. It's nothing fancy, okay? But it shows itself to be very effective. Now the reason that we use this oscillator, when you're trading a trend, like we're trading right now in UHS, strength is pivotal. It's all about the market strength. What this oscillator will generally show you is when the oscillator or when the market itself is losing too much strength. This market, think about it. We traded up to about $100. Right now we're at $92, right? The market's given $8 back of this trend. If it gives 10 back, if it gives 12 back, how much money can this trend give back before the chance of it re-rallying really diminishes? The oscillator is used for this too. What we do on the oscillator is we give it a zone. I'm going to measure the strength of the market. The strength of the market is the oscillator. So from where we last crossed to 0, which was back here, I'm going to draw a couple more arrows around that point. That's the 0 line. I'm going to measure from that 0 line to the peak, the highest part of the oscillator, which is right here. Okay? I'm going to measure this with a retracement, a Fibonacci retracement. And I'm going to measure from there, which is the 0, all the way to the peak, right up here. Now, what we've learned through history, and I'm just going to do this real fast. I don't have my, oops. Had a little screen artifact from sharing there. My screen's flipping around a little bit. Sorry about that. Let me, I'm having a little technical issue here. What I'm doing real quick, you can probably see it. I'm using a split screen that's kind of going a little bonkers on me. I'm going to measure this oscillator for a retracement. All right, so do this. Oops. There we go. All right, sorry about the little goofiness there. For some reason, my screen sharing got a little bit strange. I'll give it a couple seconds to kind of come back for you guys. All right, so what I did is I took my oscillator. I'm going to make it a little bit easier to see. I'll make it red. All right, so on the bottom, I've made this. Oh, I need to make this one thicker. There we go. Now you can see it a little bit better. I'll wait till that kicks off for a second here. All right, there we go. Now you can see right here we've got a 90% pullback. That's basically a pullback to 0. And then you see that red line down here? Right down there. I just put an arrow down by that red line. That red line is where the oscillator can retrace to at its maximum level. So what we're going to do is we're going to use this oscillator as a gauge of strength. Okay? We're going to use it as a strength gauge. If this oscillator starts going lower and lower and lower and gets below that red line, that tells us that the market has lost too much of the strength. It's probably going to reverse at this point, and the wave 5 is not going to come in. We're just going to see a complete failure of the Elliot sequence, and the market's not going to re-rally to a 5. Now, when you see something like that, what do? Well, the first thing that you would do is you don't want to buy UHS if this happens. It didn't happen to UHS, but if it were, you wouldn't want to buy it. You'd probably want to start selling it. And that's where that XTL indicator comes in, that red and blue bar. If I start seeing red bars and the oscillator gets to at 140 level, this is a trend breakout area, and you might want to try to sell the market. But what we're trying to do is buy into this thing because right now it still looks like it's going to make a fifth wave. The oscillator is the important indicator here. It really gives you a gauge of how the Elliot's going to work. All right, so right now, from an Elliot perspective, this thing's looking pretty good. So you've got two rules now that you're going to watch when it comes to an Elliott wave 4. Rule number 1 is the wave 4. Rule number 2 is the oscillator returning to 0, kind of crossing over, but then it pulls back no more than 140%. Right now, UHS is in that beautiful form. All right. Rule number 3 has to deal with this little red number up here in the right-hand corner. It's called the PTI. Right now, that PTI is 61. Okay. This is an index value. It ranges from 0 to 99. As long as that index is 35 or greater, that's good. Okay. Now, what the PTI is, it's a proprietary study of ours, and it lets you identify the retracement. It gives you an index value for this dollar amount of the retracement. A PTI of 61 in this case is good. If the PTI were 50, it would still be good. PTI essentially is a true or false indicator. Okay? Greater than 35 is good, less than 35 is bad. Simple as that. Don't get too caught up in the numbers, because when we ran the statistics and we continually update these things, 37 is good, 38 is good, 39 is good, 90 is no better, etc. There's a very, very, very minute statistical difference in those. Basically what I'm saying is this. If you think about statistics, right? If I tell you something is 60% effective, and if I tell you that if you trade a PTI of 36, it's 60% effective. But if that PTI is 90, it's 60.00026. That's statistically irrelevant. And that's really what the numbers are. 35 and greater is good, 35, less than 35 is bad. So don't overread the PTI. Don't look at a trade and say, well, I've got a 90 on this one and a 50 on this one, so I should go with the 90. It doesn't work that way. And quite frankly, I always joke with Tom about this. If we could go back in history, we'd probably do the PTI differently, and we would just say PTI good or bad or something like that. Okay, but it is what it is. The software's been on the market for 25 years. It ain't changing now. All right, so that's rule number 3. The profit-taking index has to be greater than 35, and it is. The last rule are these channels right here. You see a blue channel, a green channel, and a red channel. Blue, green, and red. If the wave 4 does not exceed the blue channel, that means it's the strongest wave 4 you've got. It's got about an 80% chance of going higher, okay? But this one has not. It's actually down to the green channel at this point. If the market retraces down to the green channel, now you have about a 60% chance of this market making a fifth wave. If we go below the green and down to the red, now you have a 40% chance of this market making a new wave 5 high, 40 to 50%, okay? So bottom line is you don't want to get it past the red channel. Even if you're 45% accurate and you go on the red channel, you can still make money on this trade. Okay, it's still got potential to make money. But the bottom line is don't let it go below the red channel. Going below this red channel is akin to letting it go below that oscillator. It's letting you know that the market is too weak. Once the weakness is past the turning point, it's very, very difficult for this market to regain enough strength to pop up to a new high. So this right here is what we call the advanced get type 1 trade. All right. Now the type 1 trade is a perfect example of a highly predictable move. What happens after this? Well, we would want to come in with an entry technique. I like using regression trend channels or a linear trend line. Something like this. When that market pops, like it does right there, boom, that's where you're going to go long. And if everything works out, what's the market do? Makes a fifth wave high. Now, where was that fifth wave high supposed to occur? Let me go back a bar. You see this line right here? this little hash mark, oops, not that one. You see this little dot right here, that little hash mark? That right there is your wave 5 target. That's where this market typically will go to based on there. Now, as far as some of the questions that popped in there, I just saw those. My question thing got closed when I had all those screen trouble issues. Your stop right below the wave 4. So what I would do in a trade like this is I would go and look at my stop, or I would look at my data window here. And I would say, all right, based on, let me get my open, high, low, close thing here. Based on that price about right there at 91.12, I'd probably put my stop about 50 cents below that low. So on a trade like this, my stop would be right down here. Okay, I'd be risking about that much. So I'd be risking, you know, if I want into this thing at 95.70, my stop would be around 90.50. I've got about a $5 stop on this trade with a potential of this thing going to about 106. So I got about an $11 profit target and a $5 stop if I'm trading this thing on the stock side. Okay, if I'm just buying a stock, I got about a $5 stop with an $11 profit return. Now, what I'm going to mention here when I flip over to the options point of view, it's going to be reversed a little bit. When you are doing a type 1 trade like UHS, what I typically want to see in a type 1 trade, I want to see a 2-to-1 reward to risk. For every dollar I have to risk, I need to see twice that. So if I'm risking $5, I need to see a $10 potential profit. And I've got it here with that fib. I'm risking 5, I've got 11. It's a little bit greater than 2-to-1. So we're good to go on this trade. If it's less than that, I probably would shy away from taking this trade. Now, from the option point of view, I might still take the trade, quite frankly, if I've got less than a 2-to-1 reward risk. Now, that decision has to go into the options, okay? That decision would have to go into the options to see if, you know, there was enough reward risk on the option front of it. And I'll get into that here in just a second. Couple questions that pops in there. Okay, that's the stop. What is PTI indicating? The PTI, again, is basically just a numeric index, and all it does is it looks at how much price we've gained in wave 3 versus how much price we've given back in wave 4. It's just a numeric index. Now, you see the PTI is gone. That's because the PTI is not important anymore. It's already in wave 5. The pattern's already complete. Okay, and then how do you identify the wave 5 target? The software basically does it for you already. That's that little hash mark up here. Now, if you're wondering what that hash mark is, that is just a 62% extension. So I can measure my wave 5 by measuring this complete sequence. I can go from 1 to 3, where the 4 is, and you'll see up there that is a 62% extension. And up here is another little hash mark 5. That's a 100% extension. Now, when you're measuring your potential profit targets, always go conservative. Okay, conservative means use the first one at 62%. That's the conservative one. Okay, so I'm not going to say, okay, one up here at 117, that's what I'm shooting for. Well, yeah, in a perfect world, that's what I'm going to shoot for, but it's not a perfect world, so always use the first one or the conservative mode. Okay, and then now, Bob, to your question, what is the fib on the red channel? Those channels down there, by the way, those are not Fibonacci based. What we did is we created, those channels down there are actually based on moving averages. And what the software does is it takes a look at the ratios of waves 1 and 2, and it comes up with 3 moving averages for your wave 4. Okay, it's kind of like a living, breathing retracement. All right. Now, typically your wave 4, just so you know, if you're looking at retracement areas, typically your wave 4 retraces about 25 to 38%. And this wave 4 right here is kind of testing that 38% level. The 62%, which is right here, this is really, and I'm going to thicken that one up because it's the most important. If you're wondering about fib retracements themselves, that's around the 62% level. It's pretty close, but those moving average lines, that blue, green, and red one, those are not fib-based. They're just moving average-based based on the structures of 1, 2, and 3. But you'll notice a lot of times that that red channel, most of the time, will kind of, cross around that 62%. 62%, in my opinion, is probably the most important fib level there is. Okay, 62% is critical because it really tells you when the market's going to change directions. When a market retraces more than 62%, a lot of times this is where the trends will fail. So there's really no kind of, the fact that that red channel kind of crosses with that 62% level, a lot of times your oscillator will be around that level. 62% really is the critical level for fib, especially as a trend trader. That's where you really want to focus. Okay? All right, next question that popped in there. Great question. Do we have capability of looking for these kind of markets? We absolutely do. I'm going to take this screen, and what you'll notice now, I've got a chart on the left, and I've got my scanner on the right. Now, what this scanner can do, this is called the Advanced Get Scanner. Okay? And hopefully you guys can see this. I'm going to reshare my screen real quick because it doesn't look like it's popping in there. Either that or I'm just delayed a little bit. Either way, I reshared it for you guys. All right, over on the right-hand side, you see this big list of symbols? Right here, this is a scan that I did earlier to find UHS. See, UHS is listed right there. Now, what I did to find UHS is I looked for what was called the Type 2 trade. But there's a little filter button right here in the top. I'm going to click on Filter. And under my technical analysis, I have a little drop-down menu where pre-built set is right here, and there's a list. I can do Type 1 buys and Type 1 sells. Now, what you're seeing on the Advanced Get side, this is only one phase of what we can do. You'll see that there's other trades like buying with the trend, stochastic buy, XTL breakouts. You can also do a scan just for individual Elliot counts. Here's a wave 3, here's a wave 4. We've got some technical scans in there too. You can do moving averages and things like that, all kinds of stuff. So yes, we can scan for this. And then, matter of fact, that's what I'm going to do right now. What I'm going to do on a daily chart, I'm going to scan for Type 1 buys. Okay, all Type 1 buys. So under Filter and Options, I'm going to go over here and say, this looks pretty good. I only want to do Type 1 buys that have about, I'm going to change that to about $1.50. A minimum of $1.50 3-day average range. You kind of see me changing that right in here. And I want to make sure that the stocks on average trade at least 750,000 shares a day. I don't want to be trading something that only trades 1,000 shares a day. I need to have volume in this thing. So I'll hit Apply. And here's a list of stocks right now on a daily chart that are all potential Type 1 candidates. Tesla, TripAdvisor, Netflix right now is a really good one. I am really trying to get into Netflix next week. That's my goal. I wanted to get into Netflix on Friday, except for the fact that Netflix was still down on Friday. I will not take a trade on a down market. All right? Now, let's take a look at Netflix, because Netflix is a trade that I'm really kind of hyped on anyway, because I actually want to put some money on this thing. Here's Netflix right now. Take a look at some of the rules that I discussed. It's a wave 4. The oscillator looks good. It's a little bit below 0, but that's fine. Remember, it can't pull back more than 140, and it's not. The PTI is 64, so we're good. And we're between the green and red channel. So we've only got about a 50% chance at this point of Netflix making a new high. 50% is fine. I am completely okay with that. Okay? So if I'm buying Netflix, here's what I'm going to probably do, and here's what I am doing. I have a trend line on Netflix that extends from the 3 across this high, kind of across that high. Now, I'm kind of taking that little spike bar right there. I'm kind of taking that out of the equation for this one, and I'm not focusing on it, okay? Because it's like a one little bar spike outside of the typical retracement. What I want to see on Netflix is I want to see this thing break that level, get to about 435. And my target on Netflix is going to be up here, right around 520. you know, it's got about a 50% chance at this point of making 520. All right, so this is how I'm going to set the trade up if I was buying the stock. Now, what I want to do is I want to do an option on Netflix. Okay, I want, and oh, one thing I left out. For a stop, you put your stop below the wave 4 low. The wave 4 low is about 418. I'd probably put a stop at about 415, a little bit of white space underneath that wave 4. Once my line gets in there, you'll kind of see where I'm going to go with it. Okay, right below that, not the actual number wave 4, but actually below the data. Now, what I want to do on Netflix, I want to do a credit spread. I don't want to just buy Netflix. I'm too cheap to buy Netflix, okay? I don't want to spend $400 a share for a stock, and even options on Netflix right now at the money are going to be pretty expensive. So I want to do a credit spread. I love trading credit spreads because they pay you up front. So what I've got to do is I'm going to do what's called a bull put spread. All right? I'm bullish on Netflix, but I'm doing puts because I, as a credit trader, am going to be an option seller. I am going to sell out of the money puts on Netflix with the hope that they expire worthless. All right? So one of the new features for eSignal 12 is an add-on called Options Analytics. What I'm going to do, I'm going to right-click on Netflix on the chart, and I'm going to go open in Options Analytics, and I am going to click on Spread Select, and I am going to do a bull put spread. Okay? Hopefully you guys can see that menu here shortly, or if you can see it now. I'm right-clicking on Netflix in my scanner. I'm going to Spread Select, and I'm choosing bull put spread. Left click. Now, what this software, what this options add-on is, this portion of it is called the Spread Select tool. What I'm going to have Options Analytics do is build me some spreads on Netflix that I can take a look at and analyze. Okay? And I'll kind of work through this as I go through them. Now, what I want to do, I want to look for options that expire. I'm going to do August 16th is pretty good. This is a daily chart, so I expect it to go up a little bit more. Okay? So what I'm going to do is I want to start right at the money, 422.50. I want to go below the money. Okay? I don't want to go above it. I want to go below it, and I'm going to set this thing up to show me a few spread candidates. Okay? So what it's just done is it's built me about, let's see, 1, 2, 3, 4, 5, 6, 7, 8. I've got 9 potential bull put spread candidates on Netflix. Now, the key thing is what we want to go over to the right is we want to look at this kind of stuff. Credit, that's given. Maximum profits are, of course, the credit that we get. The risk associated with the trade. And then another important thing is this probability area. These last 7 columns or so are the most important columns of this particular instrument. All right? Now, what I want to do, and I'm not saying that Netflix, by the way, is going to be a good candidate for doing this, but I'm working it through with you right now. What I want to do on Netflix, I want to trade a spread that has a greater than 80% chance of going in my direction. All right? Now, when you look over here into this probability in the money area, right here, this prob ITM, that means what is the probability of that option expiring in the money? Now, I do not want that option expiring in the money. That's bad. Okay? I'm selling an option here. I don't want it finishing in the money. I want it to finish with 0 value. Now, the one that I'm concerned about is the one that I'm short. So let's take a look at this first candidate right here, the bull put spread. I'm buying an August 16th 385 put, and I'm selling an August 16th 390 put. Take a look at that 390 put. That 390 put has a 14.4% chance of finishing in the money. That means based on historic volatility, that's what this probability in the money is based on, okay? Based on historic volatility, this option has an 85% chance of expiring worthless. 85% of the time, based on history, that option will expire worthless. So what I'm going to use that 85% as a calculation for my reward risk. This trade on one contract is going to give me a $50 credit, 54 bucks. To take this trade, I'm going to have to risk $446, right? Okay. This is the options analytics platform. This is an add-on to eSignal. So no, this Thinkorswim wouldn't have this particular platform. This is something that eSignal provides or offers. All right. So if I take this trade right here, I am going to get a $54 credit, and historically, I'm going to get that 8.5 times for every 10 trades I take. Based on that, I am going to make $459 on 8.5 winning trades. Now, if I lose, I'm going to lose 446, and I'm going to lose that 1.5 times. Okay, that's based on an 85% historical probability. What that tells me is that trade's not going to work. I can't take that trade because for the winning trades, I'm only going to make about $450. And if that trade goes against me 1.5 times out of 10, I'm going to lose more money than I make. That doesn't have the proper reward risk spread breakdown. Okay, so we got to go up a little bit. Here's one at 74%, all right, with a probability of about 18%. So we'll just work that from an 80% perspective, all right? So 80% of the time, I'm going to make 74 bucks. That's 592, all right? 20% of the time, I'm going to lose 426, 852. So that trade right there still doesn't quite get it done. So I'm going to have to keep going down this list trying to find a reward risk breakdown that works. Here's one that's 100 and 400, right around that 77% probability. Now what I want to do with this spread, I want to show you how this works, right? Take a look at the third spread. I've got a $100 credit with a $400 risk. That's got about a 76% accuracy or a 76% probability. I'm going to right click on this bull put spread. And I'm going to go to one of our other proprietary tools in options analytics called the projection. So I'm going to click on projection. Now what this projection tool will do, it does kind of exactly what it sounds like it's going to do. It's going to project my spread. Okay? It's going to project my spread. Oops, I just closed the software. Give me a second so I can. Sorry about that. I accidentally closed the, so I was reaching for my screen sharing thing and I accidentally closed the software. All right. There we go. All right, now, what this projection tool does, this is basically what I like to call, for those of you that trade options, this is a risk graph on steroids. What this projection tool will do is it shows me how in the future, up till expiration, you see this middle pane right here? This is middle pane. I'm going to make it a little bit bigger so you can see it clearer. This middle pane is essentially the daily chart of Netflix. It's a daily chart of Netflix with this little purple cone, okay, going out to the last date. That's April or August 16th. That's when the option expires. Now, what I can do with this cone and this line is I can project future prices. So on August 16th, if Netflix rallies to $450, look at the top. This up here is your profits. Okay? If on August 16th, Netflix rallies to $450, I make the full profit on this trade. All right? What happens on August 1st if Netflix rallies to $450? Well, on August 1st, I'm going to be making about 90% of my maximum trade. Okay? I'm still making money. All right? What happens on August 7th if Netflix sells off to $300 or $405? Whoa, took a big loss there at 395. Okay, what happens if it goes up to 405? Maybe you're gonna lose a little bit of money. Okay, still profitable. Now, do you see what happens? I am essentially trading this thing. Even if it comes back down a little bit of money, I'm still profitable in the trade. Okay, I'm going to reset that. What happens if we're completely wrong and Netflix sells off to $410 at expiration? Oh, look at that. I still make money. If it goes up to 450, I make money. If it sells off to 410, I'm profitable. It doesn't matter at this point. If I'm wrong on the trade and Netflix sells off to 410, on expiration day, I still make money on Netflix. If it goes to 450, I still make money on Netflix. That's the beautiful part of doing these credit spreads. Okay? That's the beautiful portion of doing this kind of stuff. Now, the projection tool also has another element down here for volatility. This right here is a historical graph of the implied volatility of Netflix. Right now you can see Netflix is coming off of a low. What happens if on August volatility rises? You know, you can see how that cuts into your profit curve on options volatility. You know, at the end towards expiration it doesn't matter anymore, but what this projection tool will allow you to do is kind of illustrate as the trade goes in your direction or against you, where are the levels of profitability on this thing. Okay, so we think Netflix is going to go up based on Elliott wave. This trade right here, selling the 400 put and buying the 395 put, even if the market goes against you, if the market sells off to 408 and you bought Netflix, you're going to lose money. Okay, but if you do it with an options trade, you're not going to lose money. You're going to be profitable. You're still at the end of expiration profitable, even though the market did not follow Elliott sequences and went down instead of up. So you are combining essentially a high probability Elliott sequence with a high probability trade setup. Okay? We have a good reason to believe Netflix is going to go up. But now we've got even a higher percentage because we're giving this thing such a big buffer, essentially. Okay? So even if it goes against me a little bit, I still come out successful on Netflix. That's the beautiful part of this. Now, another thing that you can do with options analytics, which is really cool, I kind of showed you the spread selector so we can kind of go through all the different spread candidates we have. Okay? If you have a directional bias on something like Netflix, you can actually set this a little bit tighter, right? You can move up to right here and say, all right, on, you know, this one here is about a 70% chance of working with a 30% probability of finishing in the money. This trade right here might be okay at the 400, 405 level. You know, we can look at that. So we've got directional bias. We can, you know, go even a little bit farther. Now, one of the things that I like to do in a perfect world, I'm going to go back to e-signal real quick. This right here is a list of all of the type 1 buys right now that are, you know, pretty strong. And they have at least a $1.50 3-day range. I'm going to change that down to none. And I'm going to get a bigger list. Well, I was hoping to get up. There we go. There's a much bigger list of stocks. All right. Now, what I'm going to do, these are all potential type 1 candidates. I'm going to take this entire list of stocks, and I'm going to take that list into my options analytics program, and I'm going to do something that's called the matrix. Now, the matrix is an option-based scan. I'm going to scan all of those stocks, okay, in the software, and I'm going to look for options that have high volatility. Because typically what I want to see for credit spreads like this, you want to see stocks that have high volatility. Okay? These right here are all stocks that are type 1 buys with high volatility. High volatility means overpriced options premium. Now, not any volatility. It's got to be high implied. So what this scanner does is it looks at the difference between implied and historic and ranks them in order. Okay? So these are all possible type 1 trades that all have volatility, high options volatility. Let's take a look at BLDR. So BLDR, I'm going to open that up in a spread select, and I'm going to do a bull put spread. I'm going to go below the money, and I'm going to set this number of strikes up a little bit farther. Okay, that's a relatively inexpensive stock, so that one's going to be a little bit rougher, it looks like. All right, here's more expensive stocks. Pinnacle West. All right, let's take a look at Pinnacle West. Spread select on Pinnacle West. I'm going to do a bull put spread, and I want to go below the money, and let's set the number of strikes out a little bit farther. All right, so if we get enough data on this, we can start assembling spreads on Pinnacle West. All right, so it's a matter of looking for good type 1 candidates on the e-signal side, bringing that information into, options analytics, looking for good trade candidates at that point. Typically, we want high volatility, high, options volatility, like here's IDTI. I pretty much would like more expensive stocks too. I'm going to change it up to $50 on the advanced get side. That way I'm not left with a bunch of, low stuff. Here's a much smaller list to choose from. So I'm going to copy that over, bring that into the matrix. And hopefully that worked. I don't think that's going to bring over quite right, but we'll scan that for high options volatility. So yeah, there's kind of the list right here. Oh, I forgot to check the list. That's why. All right, there we go. Much better. All right, so here's Christopher Banks. We can do a spread select on Christopher Banks. The only problem is it's pretty cheap. It's not bringing my list over quite right. Let's go to risk graph. Okay, so you can kind of see how you set this type of stuff up. Here's wave 4 kind of coming in on Vectron. It's at this point, what I want to do is I want to build a spread around that. So maybe, I'll sell a $38 put or a $35 put, and I'll buy a $40 put. And we'll see how that kind of, I meant $30 put. I always do that wrong. Something like that. Now, wow, this thing's really out of whack. Oh, because there's no volume in it right now. But this is kind of what you're doing. You're selling an out of the money put, and then you're buying the next put out for insurance, essentially. Now this is option, and that's what it's called, options analytics. Okay. Now I'm going to share another screen with you. This is the eSignal website. If you click on, and this is just eSignal.com, okay, click on Education and Events. Now, under Education and Events, we have webinars pretty much every week. You'll see the one listed here, using Elliot Wave for high probability option trading. Click on Webinars and Events, and this is a list of all of our upcoming classes. Now, every Monday, I do a class on trading options using options analytics. So that's this class right here. We have one on July 28th at 4 p.m. Okay, that's Monday. Register for it, take a look at it. That's where I'm going to delve deeper into the options analytics platform. Now, if you're more interested in the advanced get side, you'll see trading stocks for greater profits. You'll see trading futures. These are all advanced get specific classes. Now, if this software looks interesting to you and you want to kind of explore it a little bit more, all right, I'll give you a quick breakdown of things for it. The advanced get software, okay? The advanced get software that I used to do the Elliott wave analysis, to do the scanning that I did to find those type 1 trades. The advanced get software is $295 per month plus exchange fees. Okay? You can also purchase it. You don't have to lease it on a month-to-month basis. You can buy advanced get. The normal price of advanced get, and if you click on this pricing tab right here, kind of shows you how it works. The month-to-month price for advanced get is $295 plus exchange fees, or you can do a one-time purchase for $39.95. Now, if you are interested in advanced get, talk to our sales reps. I'll give you a 1-800 number here in just a few minutes, okay? By coming to today's class, if you purchase Advanced Get, we actually cut that down to $32.95, where it says right down here, attend a free seminar. You've attended a free seminar of ours, you can call and get that $700 discount. It's $32.95. That's a one-time purchase. Now, Advanced Get is a very thorough trading package. It's going to take a little bit of effort, a little bit of work on your part to learn it completely, but we're going to be there every step of the way. On the Advanced Get side, okay, on the Advanced Get side, we offer you mentoring 3 times a week for 2 hours. We open up one of our eSignal web rooms and we do real-time mentoring. You're going to be able to come into that mentoring class. You're going to be able to, ask us questions. We'll show you charts. We'll set up trades with you, answer any questions you have on the Advanced Get side. Now, from the options analytics side, okay, if that's something that you're interested in, the options analytics package is both a standalone software and it is an add-on software. So you can use it in conjunction with Advanced Get, like I showed you, okay? Or you can just use Options Analytics as a standalone product. It's got charts, it's got everything you need in there to trade options and do basic indicators. It's got that matrix, that projection tool. The Options Analytics add-on is $250 per month, okay? $250 per month, maybe it seems like a lot of money. Let me tell you, $250 is one high probability credit spread a month, okay? It should pay for itself relatively easy. How can I claim that? Well, here's how I'll claim it. Every Thursday at 4 p.m., I do a mentoring on Options Analytics. Every week, I will be pulling trades in that class. Last week, we looked at Green Mountain Coffee as a bull or as a bear put spread or a bear call spread. This week, we found Ralph Lauren. We found another one. We were looking at Netflix. We found Dish Network. We're going to be finding trades using the software every week in this 1-hour class. It's on Thursdays. If Options Analytics is something that looks interesting to you, again, you can give our eSignal sales reps a call. That's $250 per month. There is no purchase for Options Analytics. You have to basically buy that software. Okay, it's a one-time purchase. Let me pause my screen sharing for just a moment. Okay, I want to give you a number. There we go. All right, if it's something that you're interested in, you should see my screen now. I've got an email address, the website, and our contact information for eSignal sales on the slide. Give our guys a call. Make sure you tell them that you were at today's class. Okay? Monday, we have an Options Analytics course that you can come to and learn a little bit more about the Options Analytics software. We also next week have Advanced Get classes that are going on next week, so feel free, by all means, to attend any one of those events. My name again is Ron Wheeler. I'm one of the Advanced Get and Options Analytics educators. I've been using Advanced Get for 17 years in my own personal trading, and I've been using Options Analytics since it was designed. I'm part of the design team for Options Analytics, so I know quite a bit about that software too, as I was involved in the design and implementation of how it works. So, if you have any questions, by all means, I'll kind of read through the chat here, but eSignal.com, AdvancedGet.com can kind of get you all the information on all of our product offerings. Combine them up, high probability trades with high probability option strategies. Quite frankly, you can't go wrong. I'll be honest with you, this has totally transformed the way I've personally been trading in the last 5 years. I don't trade a lot of futures anymore because futures require a lot of work and sitting in front of your screen all day. I do a lot more stocks now where I'm just doing these credit spreads, and I'll tell you, it's just an easy, high probability way of doing the trades. So give us a shot, give us a call, and we'll be there standing by. So thank you.
Ron, thank you very much for a wonderful presentation. Hi, everybody. Thanks again for hanging around to the end of our session today. We will be processing the video of all the presentations that our presenters have done today. It should be available on valuecharts.com/blog. Just go right there to that page, and you should be able to watch the recording. Give us about 24 hours, because believe it or not, it takes longer to process the video than it actually takes to record it. And then we have to upload it to the video servers, which takes the same amount of time. So we appreciate your patience. We appreciate your time and look forward to hosting you in the future. Thank you.